In today's lesson, we're going to be talking about specifically an introduction to life insurance policy types. This is kind of the formal beginning lesson of Module 3, discussing all of the different kinds of life insurance. I'm going to get very detailed later on in different modules in this masterclass if you're watching the whole thing, or in separate modules as well. So learning objectives include today discussing and explaining why different life insurance policies exist, why there's not just one type, distinguishing between temporary and permanent life insurance. Very important to understand the differences for yourself as an agent, but to help people too, and pass tests. And differentiate between fixed and variable policies, recognize policies with flexible versus fixed premiums. And lastly, to build a framework for comparing different kinds of policies on the licensing exam so you get these questions right. So let me start off with the first question I think it's important to understand is that the common misconception the public has is that all life insurance is the same. And it just isn't the case. So why is there multiple types? Well, it's because people have different needs. They have different goals. And what you need to think about life insurance is it's not some sort of perfect fit for everybody. There's people out there who commonly critique different kinds of products and they say they're trash or bad or a ripoff. Well, the problem with those perspectives is that really they look at life insurance the wrong way. They don't look at the individual requirements or reasons why one would own one. So the best way to look at life insurance in short is they're like tools in a toolbox. And you take that tool out specific for the problem at hand. It's not one tool for everything. Then you've got a bunch of mess. So understand people have different financial needs. Some people need inexpensive temporary coverage. A lot of people do. Whereas some people need a lifelong policy that lasts forever that has cash value or cannot expire. And so these are why these exist to solve problems effectively. So remember, ask yourself, what problem is this policy trying to solve? Conceptually, that's going to help you understand why you would choose one or the other and prepare better for the exam as well. So there's 4 types of questions that unlock every life insurance policy so you can better understand how it is and how it'll be showed up on the exam. So is it a temporary policy or is it permanent? Does it terminate or does it last your whole life? We'll talk about that more in a minute. Does the policy have cash value or not? Is there a fixed or flexible premium? And who bears the investment risk? Once you know these 4 characteristics, you'll understand almost every life insurance plan that you'll ever encounter. So a little bit of detail here going into the difference between temporary and permanent insurance. First of all, temporary covers a specific time period, right? It's not a forever plan. It's for a specific time period. So temporary means it doesn't last forever. So it's a term. Term is the very common term for term insurance or for temporary insurance. Typically, with temporary insurance, there's a lower premium. Why is that the case? Because the likelihood if the insurance company is issuing a policy is that they're going to issue it so that the likelihood is extremely low that the person will actually file a claim. So they likely will outlive it, actuarially speaking, statistically speaking, so they can price the plan lower over a group of insureds in an insured pool. There's usually no cash value in most temporary insurance plans, and it ends when that term on the policy expires, whereas permanent insurance covers the assured's lifetime. So you can't outlive it as long as you keep up with the premium requirements. Typically, because there's that guarantee it'll be there when you die, it's a higher premium. It also builds cash value and remains in force as long as sufficient premiums are paid or policy cash value supports policy charges, okay? So this is kind of what it looks like. Track 2 is coverage starts and it ends at the expiration. That's term. Permanent is coverage starts and then it continues for the life of the client, the client, as long as policy requirements are met. Okay. So again, term insurance is temporary. That's really the best way to remember it. Okay. All right. Premium flexibility. Now, some premiums are flexible and policies have premiums that never change, and then others allow to adjust. So, for example, premium fixed policies include things like term, whole life, and variable. It lays out in the plan that for that specified period of time, that premium is what it is. Sometimes it's the same for the entire length of the plan. Sometimes it alters based off of what we call bands. We'll eventually talk about that more. Or you can have what's called flexible premium policies, where the policy owner may adjust premium payments within policy limits. So this includes universal all variations of universal life plan, including plain universal life, variable, or index universal life. And it may allow adjustments of both premiums and death benefit depending on policy provision. So the way to think about fixed premium versus flexible premium is flexible premium gives you, the insured, the policy owner, the option to adjust the premiums. It's going to change things, whereas fixed premiums don't. Okay. So flexible premiums are one of the easiest ways to identify universal life plans. So if they have flexible premiums, they're always a universal life plan. Okay. So the other question asked is who bears the investment risk? This is very commonly tested, and that the insurance company bears the risk if it's a whole life or universal life, or the policy owner bears the risk if it's a variable life or universal variable policy. So in other words, if it's variable, the policy owner bears the risk. If it's not, then the insured bears the risk. Okay, insurance company, excuse me. Because money is invested in separate accounts, policy values can rise or fall with the market performance. So remember, variable means investment risk. That's the best way to think about it. With investment risk, you have the upside potential, but the potential for downside loss. Okay? And then compare every policy using these 5 questions. So again, ask yourself, is this temporary or permanent? Is there cash value or not? Fixed or flexible premiums? Who bears the investment risk? And who's it best designed for? If you can answer these, you'll do fine in this particular section, okay? So some key takeaways: different policies solve different financial needs. Policies can be classified using 4 core characteristics. Remember, term insurance is temporary. Permanent insurance generally builds cash value. Variable policies shift investment risks to the policy owner, not the insurance company. And universal policies typically offer premium flexibility, okay? So here's a chart here. Again, you can download this at our Life Health Exam Coach school link. That link is below. And then study this to help kind of situate everything in your mind. Okay. And this will come in handy as we go through it. So let's pop quiz time. Let's go over some questions here. Which characteristic best distinguishes term life insurance from most permanent life insurance policies? Is it A, it provides a death benefit? B, it requires medical underwriting? C, provides temporary coverage for a specified period? Or D, it may insure more than one person? The answer is C, and it provides temporary coverage to a specified person because term insurance provides protection for a specified period. Definition. While permanent life insurance is designed to provide lifetime coverage as long as policy requirements are met. Question 2, an applicant wants a policy that allows premium flexibility. Which category of life insurance is most likely to meet this need? Is it whole life, universal life, level term, or industrial life? The answer is B, universal life, because universal life policies are known for their flexible premium structure. Universal life, flexible premiums, making them a common licensing exam answer whenever flexibility is mentioned. In today's training, I'm going to be talking about term life insurance and understanding exactly how it works and understanding temporary protection, where bottom line, it's simple, affordable, yet temporary. So let us begin. Our learning objectives, of course, today include your ability to be able to define term insurance, explain why the premiums are lower with term than other options, identify major policy periods that are common with term, explain renewable and convertible provisions, very important to understand, compare level with decreasing term, and recommend appropriate situations depending on what your client needs to accomplish. So, what is term insurance? Term insurance is temporary coverage where the policy starts and ends at a predefined period of time. Okay. So, in other words, it's temporary. It's term, terminates. Is another word. The term terminates. Okay. So, you get coverage within that period of time, of course. However, the tip here is to think of term insurance as renting. Yeah, you like rent a house. You ain't going to live there forever. It's for a period of time. It's the idea behind term. You're keeping insurance temporarily, only during the period. So term insurance provides the following: a death benefit, just a death benefit, okay? No cash value, coverage for that specified period of time, and premiums are payable only during the selected term unless renewed, unlike cash value, whole life, permanent plans. We'll talk about that in a minute. Coverage ends for term insurance when term expires. So you got a 20-year term, you get a day past 20, it's done, it's gone, it's over if you didn't renew it. Or if you just stop paying it and the policy lapses, it's gone. Or the insured dies while the term is in effect, and that's when it ends. So what the exam wants you to know, and what you'll be heavily tested on, is term insurance provides temporary protection only with no cash value. That's the main thing. So one of the things you'll know if you've ever priced out life insurance is term insurance comes in substantially less expensive in terms of premium relative to permanent options like index universal life or whole life plan. So why is that the case? You need to know so you can explain it and answer the questions right. So first of all, permanent insurance is designed to provide lifetime coverage if premiums are maintained, making it much more likely to pay a death benefit than term insurance. Okay. So term insurance pays only if the death occurs during the selected term. All right. So most policies expire without paying a death benefit. So if I'm an actuary, these are the brains behind the scene that design the products, and they know kind of the odds of someone dying at a specific age, and they assign us essentially a level of risk, and they allow someone to be approved for a policy. They know statistically if they limit the amount of years that they're covered, that they can offer a lower premium because the statistical probability is so low that it's going to pay out. Does that make sense? So because you're not guaranteeing it till the any time that you die, you can offer the price much lower and much more competitive than other plans at the equal amount of coverage that are permanent in nature. Okay. It's like there's no guarantee. So that's what since you're not paying for guarantee like other plans that it'll pay out no matter when you die, you pay less. Okay. So lower probability of dying means lower premium. And understand for the exam, term insurance is less expensive because the insurer is statistically less likely to pay a death claim than under permanent insurance. This distinction appears a lot on the exams. And again, most expire without paying a death benefit, and term is less expensive because the insurer statistically is less likely to pay a death claim. So key points here. Term insurance is temporary. The benefit is level, decreasing, or increasing depending on the policy design. There's no savings component like a cash value plan. It has the lowest initial starting premium. It's simple to understand. It is pretty simple and straightforward. And it can expire with zero value. Okay. Pay all those premiums for nothing. Now, stop and remember, first of all, term insurance provides temporary protection, no cash value. It's less expensive because claims are less likely. And key features to be tested on: lowest initial premium, simple structure, and can expire without value. Okay. All right, so let's talk about some derivations or variations of term insurance. So level term insurance is the most common type of insurance for term you're going to see out there. It's most of what is offered. It's where the death benefit remains constant and the premium is guaranteed during the initial term period. So if it's a 20-year term, that premium is a level plan for that period of time, okay? So for example, in a 20-year level term, the coverage is 500,000 in year 1, year 10 is 500, and year 20 it's 500,000. Okay, so what happens is that the death benefits do not pay or do not stay or change; they stay exactly the same. So, tip for you is that 20-year level term is one of the most commonly recommended policies to young families. So, as you're getting out there helping people with life insurance, and somebody's just getting started in their professional life, a 20-year term is very common because it's inexpensive and it does a good job of replacing income. Okay. So the thing to know with level term is a constant death benefit and a guaranteed level premium during the initial term period. All right. So common term lengths include 10 years, 15, 20, and 30 years. Longer terms, because now the company has to say, okay, is this guy going to live past 30 or die before 30? Statistically, what's the case based off of their health and age? So the more time you have to have a policy in effect, the greater the premium is to offset the potential for risk, okay? So that's just general rule with term is the smaller, the less expensive. Now, some insurers offer even more term lengths like 25, 35, even 40-year terms, but the standard in the business typically is 10, 15, 20, and 30 years. So now let's talk about decreasing term. So decreasing term means the death benefit goes down over time, whereas the premium will stay level. So you pay the same price, but you're getting less and less coverage as each year passes. This has historically been used for mortgage protection because as you pay a mortgage, the amount of the mortgage goes down. But there's not a lot of this around anymore, just as a person who does this for a living. It's tested on, you should know it, but it really doesn't exist out there. And so as the death benefit, that chart's backwards. It should be like upside down. Sorry about that. So the death benefit starts at 100. Imagine that line at 25 is at 100 and goes down over time. So remember, premium often remains level even though the death benefit decreases. And many lenders historically paired decreasing term with mortgages. Okay. So again, decreasing term has a declining death benefit, but a level premium. So then, of course, there's increasing term insurance. That's very less common. And that's where death benefit increases over time. Very rare. but you need to know it. The idea is to offset inflation. Everything gets more expensive. So if you buy a term insurance plan that's factored with an increase bought in, then it goes up and death benefit to match what the inflation rate is or get close to it. Okay. So they're uncommon, but just know that they exist. They may have some sort of rider provision to have an inflation rider. That's kind of how you can make it an increasing term insurance policy. Okay. So it looks like that. All right. So again, level term keeps the death benefit constant. Decreasing term has a declining death benefit, but level premium. And increasing term is uncommon. What you kind of see more often is ART that renews annually with increasing premiums based on age. Okay. So let's talk about ART, annual renewable premium. Renewable means that the coverage can continue without evidence of insurability, but premiums usually increase based on attain age. So, for example, in this chart, let's say you pick it up at 35 is $200 a month. Well, then each successive age older you get, it's a little bit more expensive. Okay. So there's no level term premium lock like what we talked about originally. So the key thing to remember here is premiums increase because the insured is older, not because of health change. Okay. So again, renewable does not mean premiums stay the same. And understand renewable means no evidence of insurability is required, but premiums do increase with attained age. Now, renewable provisions, this is something that's very frequently tested and important to understand. So renewable means the insured may continue coverage without proving insurability. And that's important because premiums usually increase based off the insured's attained age. So in this chart here, we have policy expires, coverage term ends on a renewal date. You renew it again without proof of insurability and no exam is needed. And then sometimes there's a higher premium that happens. Okay. So what you need to know for the exam is that renewable means no evidence of insurability is necessary to continue the plan. Okay. So now what about a convertible provision? Another important term to understand. It's a very valuable privilege, very important to understand. It allows a term policy to be converted into eligible permanent life insurance without evidence of insurability. So it looks like this. You've had your term insurance plan. You've gotten to a point where maybe you can't test for a new policy and you're worried, but you still need insurance. Well, you can opt for, if there's a conversion privilege, to turn that term into a term insurance to a permanent life insurance, like a whole life plan. Sometimes it's a universal life plan. And then the idea is to have some type of eligible permanent life insurance policy so that you have some kind of coverage going forward. Okay. So conversion is one of the most frequently tested term policy provisions. So make sure you do understand that. And then it allows term insurance to be converted to permanent insurance like whole life or universal life without evidence of insurability. That's the key thing there too. Okay. So why does this matter? Imagine you're healthy at age 35, diagnosed with cancer at 44, and your term policy expires at 45. If you don't have insurance that has a conversion privilege, you're in up the creek without paddle. But if you have a conversion privilege, you can still convert the policy in some cases and then keep some kind of insurance in place. Okay. So conversion waives new medical underwriting, but premiums will reflect the permanent policy state. So the premiums could change. That's the key thing to understand. It's going to often depend on how much coverage you ultimately arrive at. Okay. So, and again, in the real world, clients often underestimate the value of conversion until their health changes. It's really, in my opinion, really important. If you're going to sell term, the conversion privilege is just so important that clients understand that option. And what's crazy is there's I won't get off too much of a tangent here, but there are insurance companies that heavily recruit that don't offer conversion privileges because they think whole life is a scam. I mean, that's their whole business model. And these poor people I've run into in my career, they get old and they can't qualify for anything and they've stuck with these plans forever and they have to let them go because they get so expensive because the term goes up. So anyways, off my rocker here. I'll get back to the assignment here. So conversion preserves insurability even after health change. That's the important thing. So remember, renewable means coverage continues without evidence of insurability, but premiums increase with the attained age. Okay. So premiums go up. Renewable means you still keep it without evidence of insurability. Convertible means the policy can be changed to permanent insurance without evidence of insurability, meaning you can keep it as a permanent plan, even though you don't have to test for your health. So renewable does not equal convertible. Know both of these definitions, you're going to be tested on. All right. All right. What about return of premium term? So this is more expensive than standard term, but if the insured survives the term, some or all of the premiums may be returned. It still does not build cash value. Okay. So the idea here is that premiums paid, regular payments during the term, right? The policy ends and the term completes without a claim. And then, based on how the policy is designed, the premiums are then refunded back to you, the client. They're generally not considered taxable income because they're viewed as a return of premiums paid rather than investment savings. So understand that ROP term returns premiums if the insured survives, but it's not a cash value type of plan. Okay. So what are some of the advantages of term insurance and why consumers love them? This is the most purchased life insurance option out there. What's crazy is it's completely inverted where it was 50 years ago. Everybody used to own whole life. And then you had big companies come in, really push term insurance, and the whole kind of culture of approaching life insurance changed dramatically. And so, what you see commonly, especially with people who are not seniors, term insurance is the first option that they reach, and it solves a lot of problems. So, for example, it's a low initial cost. Okay, so it provides affordable coverage with a low starting premium. So this is one of the most attractive things if you're a young man, young woman starting off in life. And if you die, somebody depends on you. You need to have protection in place to replace your income. Okay. And in younger you are, the harder it is to come across money, as you know, as you build your career up in life. And so term insurance offers a way to get valuable protection for very small premiums, assuming you can health qualify. Okay. So it's a great place to start in your life insurance journey. It offers in exchange, even with a low cost, a large death benefit. Because in many cases, you're going to have bills like mortgages or your income that has to be replaced many years over, and you're going to need a lot more than you probably think. For example, it's commonly recommended that clients have 10 times their earnings per year in life insurance. So if you make 100,000 a year, you need to have $1 million policy just to replace your income, pay off bills, protect the family's lifestyle, et cetera. So term allows you to do that with less financial outlay. It's easy for consumers to understand and explain. It's one of the advantages. It's just like, hey, with term, you kick the bucket and you die within this period of time, we cut a check for this. Or, we can play with the numbers up and down. You can do it 10 years, 20, 30 years, and you pay the same premium the entire time. So it's very simple to understand, and simple things are easier to sell. And it's good for temporary needs. Remember, you don't necessarily need to always replace your income forever. You will get to the point of retiring, and you don't necessarily need to replace your income at that point, because conceivably, if you follow a financial planning strategy, you would have paid down your debts, have not a mortgage or a very small amount, and you need less money to live. And then Social Security and your savings, 401k, all that stuff comes into play. And you don't need this kind of temporary coverage anymore because you've met the criteria. That's the goal. Of course, we all arrive there differently, but it's best designed for temporary based needs. Okay. Now, what are some of the disadvantages? Because it's not perfect. It's not all rainbows and sunshine. So first of all, trade-offs include coverage ends. So if you buy a plan and your goal for it is to last forever, but you outlive it, you're not doing too well. Sure, you could always buy another plan, but who says you could qualify for it? Who says you could even afford it at that rate, right? Because now you got to apply at 20 years higher rates and 20 years older health. And there's no guarantees in life, y'all, as you'll find out if you get in the life insurance business. You have to remind people of that. Okay. Also, premiums increase if renewed. So many times I've sat down with clients, they've religiously kept their term insurance plan, and it goes from $50 a month to $500 a month. No joke. You can plot inside of the policy how it just dramatically increases over time if they're not quite there. And when you're on a fixed income and retired, like many of my clients, it ain't pretty. Okay. So again, this goes back to effective planning and picking the tool that best matches solving the problem, right? Also, no cash value. So none of these term insurance plans have cash value. So if you're looking to have a tax-free retirement or use that kind of strategy, not good. It's just pure insurance. It may become expensive later. Again, if there is an increasing term involved and you plan to keep it longer than the term, yeah, it might go up. And coverage may expire when the insurance is needed the most, which again comes back to why you should be effectively thinking through, why do you need this coverage, Mr. Prospect, Mr. Client? What do you want to accomplish? It's a very important question, because if you don't qualify that, then people will make all sorts of decisions that are against their actual goals. So this is why people need you to help them out, to help clarify these differences, okay? So best uses include young families. young families, I think, as a side note, should always start with term insurance. That's always the first product to reach for when I'm sitting down with my clients. Income replacement during working years. As you scale up your career and as you start making more money, your lifestyle adjusts upwards naturally. You need to have a significant sum of life insurance through term insurance to replace that income. And term does a great job because it's just the best bang for your buck. Mortgage protection, right? So, what happens if you die and you're the breadwinner and you've got a $500,000 mortgage? Who's going to pay for it? Do you want your kids and family to get kicked out and have to start over? No, you want to pay it off. And again, because mortgages are temporary, eventually pay them off. Term insurance offers a great opportunity to have an amount designated to paying off that amount. Okay. Also, business loans, very important too. Business loans are something that are temporary in nature, and you want to make sure are covered. Temporary obligations, maybe credit card debt would be an idea, or anything that will go away eventually. And of course, key life events that eventually you move beyond. So here's a little mini case study to drive this point home. So we got John, age 33, married, 2 children, mortgage, and a limited budget. And the recommendation here would be a 20-year level term. It's affordable, covers the child raising years when your income outlay or expense outlay is highest, protects income, and matches that temporary need. So know this for the exam. Term insurance is temporary protection. There's no cash value. Renewable is not the same as convertible. Know both definitions separately. You can see those below. Remember, you can download these slides at lifehealthexamcoach.com. It's free once you register. And then here's the question. Don't look back. See if you know this, okay? A term policy that allows the insured to obtain permanent life insurance without evidence of insurability contains which provision? Waiver premium, guaranteed insurability, conversion, or assignment? The answer is C, conversion. Conversion is correct because it allows the policy owner to obtain permanent insurance without providing new evidence of insurability. The others are wrong because waiver premium waives the premiums if you become disabled. It doesn't convert it to permanent. Guaranteed insurability allows purchase of additional coverage at specified intervals, but doesn't allow to convert term to perm. And assignment, the idea behind that is transfer of policy ownership of benefits to another party. That's unrelated to this entirely. All right, question 2. Which statement is true regarding term life insurance? It builds cash value, provides lifetime protection, usually is the lowest initial premium, or D, pays dividends. Hopefully didn't look below at the big answer. That wasn't quite hidden correctly. C, usually has the lowest initial premium. So just understand that term is just the cheapest option out of all of them. Why are the others wrong? It doesn't build cash value, as we've discovered. Term is not lifetime protection. It's terminating temporary coverage. And it doesn't pay dividends. That's an association with whole life plans, okay? So lesson summary. There we go. Temporary. Term is temporary, no cash value, lowest initial premium. Remember, renewable, convertible, and return of premium as well. And then types of term too. Level, decreasing, and increasing. Again, get the slides, lifehealthexamcoach.com. Very nice. You've done it. And we're going to now move on to learning how whole life insurance works. In this lesson, we're going to learn all about whole life insurance and helping you prepare to pass your life and health insurance exam. My name is David Duford at Life Health Exam Coach. Make sure you check out lifehealthexamcoach.com if you like this training and you want the slides, the flashcards, exam prep questions that you can test on, and more. It's a great place, and it's totally free. Look in the link below for more information. So let's learn about whole life insurance. What are we going to learn today? We're going to first learn what whole life insurance is. If you don't know it, no problem. That's why you're here. We're also going to learn how it differs from term life insurance. You may have already reviewed that training. We're going to, of course, cover how it works in conjunction or relatively to term. Understand guaranteed level premiums, very important aspect of whole life. Describe guaranteed cash value accumulation, another very important component of whole life insurance. And lastly, identify common licensing exam questions involving whole life policies. We want you to pass that exam. That's the main thing here today, and that's what we're going to focus on. So what is whole life insurance? Well, whole life insurance is permanent. Permanent, lasts forever. Remember that, permanent, permanent, permanent. Key word that shows up on the exam all the time. So let's talk about it. Provides coverage for the insured's entire lifetime. They can die at 30, they can die at 100 or older. If the plan's in place, according to the policy provisions, it will cover. It charges level premiums, so you don't see these fluctuations in premiums because of the policy becoming renewable at a higher rate, or because it's a universal life plan where they're flexible. It's the same premium fixed in place. They never change. Builds guaranteed cash value. So an important component of whole life insurance is the cash value. We'll talk about that momentarily. And it pays a guaranteed death benefit as long as the policy remains in force. So in short, whole life lasts your whole life, not just for a specified term. So let's talk about how whole life insurance works. So you pay a premium. The insurance company is the one that's covering it, and that premium goes towards a what we call a premium split, and it pays for the cost of insurance, the policy expenses, and then the guaranteed cash value. And in exchange, you get a promise of a guaranteed death benefit when you die. So this is important from the most tested standpoint. The premium split concept, okay? Please remember that, especially how cash value is built, is a frequent state exam topic. So the premium is split in paying all of these functions, okay? So key characteristics of whole life include lifetime coverage, fixed premiums, guaranteed death benefit, guaranteed cash value accumulation, and policy loans too. So if you see guaranteed mentioned a bunch of times, like that is the, the indicator, the trigger that this is probably whole life insurance you're talking about, okay? So again, side by side, let's take a look at whole life versus term. So term is temporary coverage with no cash value. Premiums are lower initially. Lifetime protection does not exist because it's terminating or temporary coverage. It expires later, and there's no cash value ownership. Whereas whole life is the inversion of all that. There is coverage that is permanent. The premiums are higher because you're buying essentially a guarantee of lifetime coverage, no matter when you die. It does not expire as long as you pay the premiums as it is intended in the policy. There is cash value ownership. There is lifetime protection and, of course, cash value. So again, memory trick, term is temporary. Whole lasts your whole life, okay? So now notice I've said like lower premium isn't, I haven't said that they've got the best premiums. I've just said they're less expensive, okay? Remember, value is subjective. Term insurance is a good value if it accomplishes the goal the best, but it's temporary coverage, but that doesn't make it necessarily better. Same thing, a whole life may not make sense for some people, even though it has more value associated, we could say, right? So again, one of those side notes here, we're looking at what the reason to have the policy is, and then helping our clients by selecting the best one for their particular situation, okay? So cash value, let's talk more about that. The best way to think about cash value, it's like a savings account built into your policy that grows slowly at first and then compounds over time, okay? And this is tested commonly. Cash value is one of the most frequently tested topics. And here's how it looks, kind of like in a series diagram. The premiums are paid. The cash value begins slowly. Then it builds cash value in a tax-deferred way. You then can do what's called policy loans once there's sufficient cash value. And then that death benefit is reduced to the equivalent cash value unless the loan is paid back. So again, cash value is not paid in addition to the death benefit in the standard policy. And unpaid policy loans generally reduce the death benefit, okay? So policy loans are not free money. Unpaid loans reduce the death benefit, okay? So there is a trade-off there. So cash value belongs to the policy owner while living. So premium structure, let's look at the premium structure. Whole life uses level premiums. They do not increase because of age, and they remain fixed throughout the life of the policy. So early premiums pay more than the current cost of insurance, which helps build excess, which the excess helps build guaranteed cash value. The insurer smooths the cost over the insured's lifetime, and then later premiums are actually, you pay less than the actual insurance cost, okay? So in the early years, premium exceeds cost for whole life, cash value builds, but in later years, the costs exceed the premium, and then earlier reserves are used. So again, why do consumers buy whole life insurance? Well, think about it. Like, why would you want a plan? What reasons would exist that you need a plan to last forever? For example, one thing is to take care of something that will be guaranteed to have an expense. So there's a couple of things that will happen. You will die, and there's a cost associated, like cremation or a burial. So you could get a whole life plan to cover that. That's what we teach our agents at my agency that sell what's called burial insurance or final expense insurance. Or for many people that are of well means, there's going to be some kind of estate tax. And so there is an argument to have whole life or a permanent plan be a sit-in to cover the estate-based tax. and to relieve some of the total burden to the survivors with a plan to do that instead. Okay. So guaranteed premiums and permanent protection are two of the most tested advantages of whole life on state licensing exams. And remember, disciplined savings is not the same as market investment account. Okay. Whole life insurance cash value is a guaranteed policy benefit. So what are the disadvantages? Well, first of all, higher premiums than term insurance, right? So if you look at the differences, people will immediately say, wow, whole life is like 4 times, 5 times, even higher relative to term. So that dissuades a lot of people simply on price. Slower early cash value accumulation takes a while to build up cash value. It's a long-term play. I wouldn't suggest it being like a short-term thing, okay? And there's less flexibility than what you'll discover shortly about universal life products. Universal life allows for some level of flexibility, whereas whole life doesn't. But understand, very important for the exam, higher premium does not mean a better investment performance. It just reflects the lifetime guarantees. So common uses include, again, like we said, final expense coverage, estate planning, lifetime family protection needs, business succession is another thing, wealth transfer, conservative, very long-term planning, and legacy planning is too, okay? Licensing exam focus, so remember, these are the key things to remember about it. We've covered them already. They'll appear a ton. You can download this chart at lifehealthexamcoach.com if you're interested. And here's a real world example. Somebody who's age 35 purchases a $250,000 whole life. The premiums stay the same and the cash value builds. There's times in their life where maybe they're in a financial bind and they need to borrow. They can. They can either surrender the policy to get the whole cash value, or they can do policy loans to borrow it out. And then the death benefit is then paid if the client keeps it up as it is supposed to, and then to the beneficiaries per the policy terms. So again, memory trick, whole life is your whole lifetime, your entire life. Term is 10, 20 years. Whole life is not for a shorter period other than your whole life, okay? So let's do some licensing questions. And then before we get into this a little bit further, let me put the spotlight on here so you don't see the answer. So, okay, a policy that provides lifetime coverage, guaranteed cash value, fixed premiums. Which policy is it? You should know that. I mean, come on, like what section are we in? Is it renewable term, decreasing term, whole life, or convertible term at C? It's whole life. It's everything we've been talking about, okay? Slide 16. Which statement about whole life insurance is true? Premiums increase every 5 years. Coverage expires after a fixed period. Cash value is guaranteed to accumulate. Or D, death benefits decrease annually. The answer is C. That's just a factor of cash value. Everything else here is more of a factor of term insurance. Okay. Question 17. What generally happens to death benefit if a policy owner dies with an unpaid loan against their whole life insurance policy value? The death benefit is unaffected by the loan. The death benefit is reduced by the outstanding loan plus interest. The policy automatically lapses with no payment, or the insurer waives the loan and pays the full death benefit. What's the answer? The answer is B. The insurer subtract any unpaid policy balance and accrued interest from the death benefit before paying beneficiaries. Why? Because policy loans are a lien against the policy. Okay. If the insured dies before repaying the loan, the insurer deducts the outstanding balance plus accrued interest from the death benefit before paying beneficiaries. It doesn't lapse, okay? And the insurer does not waive the loan. We wish, but it ain't gonna happen. Lesson 18, just a summary. Yes, summary. So again, big picture here. What should you remember and care about? Whole life is permanent with level premiums, guaranteed cash value, guaranteed death benefit, and policy loans are available. If you remember that, you'll do just fine. Howdy, y'all. Welcome to lesson 4 on the types of life insurance. Today, we're going to talk about the limited pay whole life insurance product. The purpose of this training is to give you all of the tools necessary to understand limited pay whole life, and most importantly, to pass the exam so you can get out there and help people with their insurance. So let's go ahead and get started. We're going to learn what limited pay whole life is, how it differs from ordinary whole life. There is a difference. Common limited pay options, advantages and disadvantages, and then licensing exam concepts. So you have a problem. What is your problem, you may ask? Well, let me tell you. There are consumers that want lifetime insurance. They want it forever. They don't want term insurance that terminates. They want that coverage that stays around till they kick the bucket because they have a need for permanent coverage. They want that guaranteed cash value. They think maybe it would be useful to have a backup plan to borrow money from a policy if I ever needed it. and a guaranteed death benefit. They don't want to take the risk of taking a term plan and outliving it. But there's just one little issue. They don't want to pay that insurance the rest of their life. Why do I want to pay a premium until I die? So therein lies how limited pay whole life solves this very problem. So let's talk about what limited pay whole life is. It is insurance, whole life insurance, obviously, where the premiums are paid for a limited number of years or until a specific age, but coverage still remains in force. So this is different from term insurance, where you pay it for a number of years, then you get to the end of that period and it terminates. This is whole life insurance, but you're kind of front-ending the premiums so that at a certain age you stop paying them, but still keep the coverage in place, okay? So it's lifelong coverage with a limit of how many premiums you have to pay to keep the lifetime coverage. And then once that period of time is met for those premium payments, the policy is what's called fully paid up. So it remains in force, meaning the coverage is in effect until the client dies without any further premiums left, okay? So exam trapped, limited pay is not term insurance or temporary insurance, okay? The premium period ends, but the insurance protection does not. That's limited pay, whole life insurance. So some timeline comparisons here. This is how ordinary whole life works. It continues for life until policy maturity, and then it lasts your whole lifetime. And then in this example, you pay for 20 years, and then the premiums end for the limited pay plan, and then the guaranteed coverage continues for the lifetime, okay? You'll see some, if you get out there in the field and talk to clients, you'll see some plans like life paid up at 100, so you have to reach 100 before you stop paying. This is not the primary limited pay example, okay? Most of what you see is a 10 pay, 20 pay, or paid up at 65. That's really what we're talking about with limited pay. So common designs of plans, like I said, you pay it for 10 years and it's paid up. You pay it for 20 years and it's paid up. And you pay it till age 65, kind of that idea of retirement, and then it's paid up, okay? So coverage remains in force for the life once the premiums are completed. So here's the premium comparisons if you want to look through that. And they are higher the sooner you get done paying. In other words, if I'm 40 today and I pay 10 years instead of 20, I'm going to pay a higher premium to have my plan completed and paid up in 10 years versus 20. Does that make sense? So again, you can download this chart. It's important to understand the difference here at lifehealthexamcoach.com. So cash value growth. Limited pay policies generally, year one, let me go down here, scroll down here. Paid up begins, phase begins, no further premiums are required. Cash value may increase after the premiums end. So understand that even though you've paid it up, the cash value can still improve. That's the important point here, okay? Along with coverage continuing, guaranteed cash value continues to accumulate according to the policy schedule, and no additional premiums are required. So who are the type of people that buy limited pay plans? So you can look at high income earners that appreciate the value of a whole life permanent plan, but they don't want to pay it for the rest of their life. They want to get it done and over with. Parents planning for retirement, maybe they want a tax-free way to borrow money when they need it. Estate planning clients, kind of the same reasons you would buy whole life, but kind of the payment is the issue and getting it to something that's reasonable. Individuals wanting guaranteed paid up coverage before retirement as well. So benefits include, again, everything with whole life insurance, lifetime coverage, premium obligation ends early. That's a big one, along with the typical whole life benefits, guaranteed death benefit, cash value, predictable cost, elimination of insurance expenses during retirement, so you don't have to pay that premium then, and predictable long-term financial planning. Trade-offs include, yes, it's higher than a lifetime whole life plan, less affordable for some clients. I really didn't sell a lot of these to people who are seniors. I liked to when I could because it was a better deal, but just the premium requirements are too high and they couldn't fit it their budget. So it requires greater cash flow during the working years, which means you got to cough up extra money than you would if you paid it for life, and lower death benefit for the same premium compared to term insurance, okay? So higher premiums are the trade-off for paying over fewer years. So this is the difference, or how limited pay compares to ordinary whole life. And you can download the slides again, lifehealthexamcoach.com. And remember, licensing exam tips, a couple things to keep in mind. Limited pay is whole life insurance. It's still whole life. Coverage is permanent. Premiums stop after a specified period. It's just the payments are limited, but it's still whole life. Cash value continues after premiums and then end, and death benefit remains in force. So the premium period ends, but the insurance protection does not. That's the definition of a limited pay whole life plan. So some practice questions for y'all. Which statement best describes a limited pay whole life policy? Coverage ends after premiums stop. Premiums are paid for a limited time while coverage lasts for life. Cash value stops growing after premiums stop. And death benefit expires at age 65. So I highlighted B there to try to trick you up. Are you sure it's B? Well, it is. So B is correct. So I tricked you with the trick of the trick. Anyways, limited pay whole life pauses the premium payments, not the coverage itself. Practice question 2. Compared with ordinary whole life, a 10-pay whole life policy generally has lower premiums, no cash value, higher premiums paid over a shorter period. There's that trick again. Or temporary coverage, which is it? And of course, I didn't trick you. That is the right answer. It's C. Shorter premium paying period means the same total funding is collected over fewer years, so they have to make up with a higher monthly premium. So takeaway here on today's whole life lesson, remember these concepts. Limited pay whole life is a form of permanent life insurance. Premiums are paid over a specified period, but coverage lasts for life. Shorter payment periods result in higher premiums. Cash value continues to grow after the policy becomes paid up. Common versions include 10, 20 pay and paid up at age 65. And the most test part here, premium period ends, the insurance protection does not. Limited pay is not temporary insurance. In today's lesson, we're going to be specifically talking about single premium life insurance. We're going to teach you what it means and how to identify the questions on your life insurance exam so you can pass them and actually go sell this stuff. Okay, let's get started. So what is single premium life insurance? It's a one lump sum lifetime coverage. It's that simple. One lump sum lifetime coverage. Single one premium ever paid for lifetime coverage. So let's break it down a little bit more, okay? So single premium life insurance is a permanent life insurance policy that is fully paid for with one large premium payment. Once the premium is paid, no future premiums are required. Coverage remains in force for life, assuming policy conditions are met, and cash value begins building immediately. So the key point here is one payment today provides permanent life insurance, okay? So how does it work? You pay it and you're done. I mean, it's that simple. You pay the premium. A client pays $150 large towards a single premium whole life policy. It's paid up immediately, no more bills, and lifetime protection. So think of it as buying a policy outright instead of financing it over time. It's like you pay cash up front versus payments over time. So key characteristics of the policy include having it paid up immediately. It's permanent lifetime coverage, the whole life insurance, okay? It's immediate cash value accumulation, and it's automatically classified as a MEC. Because the entire premium is paid up front, cash value accumulates much faster than in traditional whole life policies. So some advantages include never worrying about missing a premium. You just don't have to pay them because you finish as soon as you pay the first one. Immediate permanent coverage. So if you value permanent life insurance, it's a great buy. And it's simple, one and done. And there's also financial growth and planning benefits, including rapid cash value accumulation, estate planning applications as well. I see this a lot with estate planning, and may appeal to clients as significant available cash. Let's talk about the drawbacks, because there's no plan that's perfect, as you know. Single premium life requires a ton of money. You got to have cash laying around doing nothing to put into a policy like this, and it requires significant available assets and has reduced flexibility. So you're paying the entire premium up front leaves no ability to adjust or spread out the payments over time. And these policies are generally classified as modified endowment contracts. That'll show up on the exam, I assure you. So what are MECs? They are the biggest licensing exam topic you're going to run across. We have a full section at the very end of this to go over. So most single premium life policies automatically become modified endowment contracts. And all this does is changes how policy distributions are taxed, okay? So insurance coverage remains unchanged. It's still the same. The only thing that changes with that is the tax treatment, okay? So again, the thing to remember is a single premium life, think MEC, okay? So why did Congress create these MEC rules? Well, because high-income buyers used to overfund policies as tax shelters. And the government doesn't like it when you try to take their money that they think is theirs. So MEC rules were enacted to curb excessive tax advantages. And today, the death benefit remains, but the withdrawals may lose the tax brace if they're a modified endowment contract. So a little bit of tax treatment here. There's a green tier where death benefits remains generally income tax-free to beneficiaries. There's a yellow tier where loans and withdrawals may become taxable. MEC distributions are generally taxed gain first, so last in, first out, meaning earnings and gains come out and are taxed before the original principal. And also note that loans are treated the same as withdrawals for MEC tax purposes. And then red tier, possible 10% IRS penalty on withdrawals taken before age 59 and a half. So let's review the single premium versus traditional whole life. You can review that yourself. Download these slides at lifehealthexamcoach.com for free if you'd like to study these a little bit more. So who likes single premium life insurance plans? People like retirees with money laying around, estate planning clients, individuals receiving an inheritance, want to put that money somewhere, a business owner, or a client selling a business or major asset. These policies are generally designed for people with substantial liquid assets. That's the key thing. So where are they used today? Estate liquidity, wealth transfer, business succession. They fund buy-sell agreements or providing liquidity, and investing in inheritance, okay? These policies are less common, than traditional whole life, but remain valuable in advanced financial planning. So a few exam cheat sheets here. So remember, for this particular topic, single premium policies, one premium pays for the entire policy. It's permanent coverage, which cash flow grows immediately. Most single premium life policies are MECs, and it affects the taxation, not the policy coverage itself. So real world example, Susan's grandmother, Mildred, leaves $500,000 in cash. She puts it in a single premium whole life plan, and her policy is paid up on day one, and the MEC affects the loan tax. So she wants permanent life insurance, no future premium payments, and immediate cash value. And then because it's a MEC, future loans may have different tax treatments than those from a traditional whole life policy. So some pro tips on remembering how single premium works. It's one premium, permanent policy, rapid cash value, modified endowment contract, a MEC, and different tax rules. Okay. So in summary, this is how single premium works. The key idea is an upfront premium creates coverage, quick cash value, and MEC's tax considerations. So here's a memory shortcut if you want to take a look at the visual here. If you see single premium life on the exam, immediately be shifting to MEC or modified endowment contract. Now for a practice question. A single premium life policy is funded by monthly premiums, annual premiums, one-time premium, or flexible premiums. Well, because it's a single premium, it's a one lump sum premium. Answer C. Question 2. Most single premium life policies are classified as universal life, variable life, modified endowment contracts, or renewable life. The answer is C, MEC. Remember, you think single premium life, think MEC. What is the primary effect of MEC status? The policy is canceled, the death benefit disappears, certain loans and withdrawals receive different tax treatment, or premiums increase every year. Well, the answer is C. So anytime you see MEC, it has to do with taxes. Okay. Question 4, which statement is true? A single premium life requires annual premium payments. It's temporary insurance. It builds cash value immediately, or it has no cash value. The answer is C, because it is a permanent plan. It immediately starts to contribute and build cash value. And the last question here, which client is the best candidate for single premium life insurance? A college student with no income, someone who wants the lowest initial cost, someone with substantial available cash seeking permanent coverage, or someone needing 1 year of life insurance. The answer is C. Generally only see single premium life insurance sold to people with a lot of money laying around looking for permanent coverage. In today's video, we're going to be talking about universal life insurance, flexible premium permanent insurance, very common topic discussed on your life insurance exam. And what we're going to be specifically covering today includes explaining how universal life works, describing flexible premiums and adjustable benefits, also understanding cash value accumulation. These do accumulate cash value plans, or cash value like whole life insurance. Explain interest crediting, kind of an unusual thing that universal life does. Identify policy or lapse risks, very big problem with a lot of universal life plans sold many years ago. And answer licensing questions about universal life so we can help you pass the exam the first time. So where universal life fits in the scheme of life insurance, it's a permanent plan, okay? So the premiums are flexible. So we'll learn more about that in a minute. The cash value is interest-based, not guaranteed like whole life, and the death benefit is adjustable. So universal life combines permanent insurance with some flexibility. That's really the premise behind it, is to give consumers something less rigid than whole life insurance. So what really does make whole life, or I should say universal life, different? A couple of things. First of all, the premium, the owner pays a premium. It deposits into account. It accumulates cash value. There's monthly charges, so fees and the cost of insurance. There's interest creditation, so the account earns interest, and then the policy continues to remain in force. Universal life is commonly tested as an unbundled policy. So you kind of see it like it's flexible. It's not rigid. It's unbundled. It means it's kind of everything's laying out to do what you want. That's how to think about it. So flexible premiums. Let's talk more about that. How do they work? So unlike whole life, you pay more than planned, you pay less than planned, and then you skip payments if enough cash value exists. So you have all of these as options, is what I'm trying to say. So it's flexible. Look, if I have a bad month at work, I don't have to pay. Possibly if I got cash value, or I pay less. Or if I'm doing really well, I can overpay the plan more than what is planned. Okay. But the policy still must have enough cash value to cover monthly charges. No cash value equals policy may lapse. We'll talk about why that's a big problem with a lot of these older universal life plans sold. So many universal lives fail because owners pay only the illustrated minimum premium and never increase it later. This is the old, I don't want to call it a scam, but this happened to a lot of people in the 80s that switched their whole life to universal. The agent sold it as that's permanent coverage for at half the price or double the value. And the way they designed the policy was to show the minimal amount of premium to pay illustrated, which would not keep the plan into force to cover the expenses. Okay. And so these seniors would end up in, these people who are now seniors ended up in their 60s and 70s and started getting huge price increases because the cash value, which was growing, was now going down because the cost of insurance was increasing. And because the premium wasn't catching up, it was drawing into the cash value, draining it down. And then the seniors get to a point where they don't have the money anymore. And now they're at a point where they just can't afford it and they got to let it go. And it's a tragedy. I've had that happen a number of times. It continues to happen. So these are some of the issues with flexible premiums. Selling them, you want to be very careful of. Okay. So the flow of universal life, you can see this on the screen. Basically everything we already talked about. Interest crediting, universal life earns interest. The insurance company has a current rate and policy credits, or it has like a current rate and then a policy still credits a guaranteed minimum. Okay, so it just depends. So again, know the difference between the current interest rate and then the guaranteed minimum interest rate. Okay, very important. So option A, let's say you have a $250,000 death benefit with a cash value of $40K, and the beneficiary is going to receive $250,000. Okay, the option A equals the level death benefit. So memory tip, A, the amount stays the same. And note that the actual policy values vary by carrier and policy design. This is just like a simple example. Option B, you have increasing. So you have the face amount, the cash value, and the beneficiary receives $290,000. So option B is an increasing death benefit. Okay. So option B means bigger over time. Remember that. So again, all of this depends on the actual carrier's right. So adjustable features include things like premium amount changes, death benefit changes, and payments changes. Okay. So note that increasing death benefits generally requires evidence of insurability. Reducing the death benefit does not, but they may require some underwriting too as well. Cash value growth. So like whole life insurance, universal life does have cash value. The cash value grows from premium payments and interest earned. And cash value may be used for policy loans, withdrawals, or premium payments as well. Loans and withdrawals may reduce the death benefit and can increase the lapse risk. Keep that in mind. So cash value goes up, loans with withdrawals reduce it, and future growth slows because of that. Remember, cash value, using it, reduces future growth. And when reviewing existing universal life plans, always check the in-force illustration. That's actually a really good pro tip because it'll tell you what's to come and what will happen at the current minimum illustrated rate or what it actually is at and where they can expect cash value to go. So that's the biggest risk with universal life plan is that improperly designed, they can fail well in advance of what their intended use was. So they fail if interest rates fall. So it's a big problem back in the 80s. Interest rates used to be super high. And then through the 90s into the 2000s, interest rates just went super low. And so since interest rates are a function of what the universal life plans credit, they collapsed. That illustrated minimum couldn't keep up. And so you were in the situation where these people taking these plans out were not properly funding their plans, didn't have agents checking in with them. And then all of a sudden their cash value drops because it's using it to pay for the increased premium. and then their plans lapse. Premiums are too low. Again, this is why it's really important to design plans with the keeping that in mind. Again, a common trick agents use to win a deal is to say how great their price is and how low it is, but not to reveal that the low price eventually causes these problems to happen. Insurance costs rise. That's a variable that I believe the insurance companies can adjust over time. So remember, in the universal life plan is there's a cost of insurance, and that can adjust up or down and drive the price up. Cash value is exhausted. If you blow through the cash value through borrowing or because you're using that to pay the difference in what your minimum premium is versus the required to keep it in force, it will eventually reach zero. And loans and withdrawals can accelerate policy lapse. So unlike whole life, here's the takeaway. Universal life needs a lot of monitoring. This is a big thing in the sales world. We even see it now. Index universal life, we're going to talk about that in a minute, is super popular. But man, you can't sell an index universal life plan and then leave it alone. Any universal life plan, you got to look at it yearly. You have to think what's going on. It takes a lot more effort and attention than just a whole life plan where everything is just, it is what it is. And yes, there's some advantages with the ULs. This is my opinion here. But there's also advantages with the whole life because of these issues that may happen later on that we see out in the market. Universal life policies can lapse if insufficient cash value exists. So again, an example of a lapse, year 10, year 20, year 30, you buy it at 35, you pay the minimum amount, interest rates fall, and then monthly cost increases, and then that drives ultimately to not being able to afford it anymore with no more cash value. So this is the difference between universal life and whole life. Again, you can download this chart to compare the differences at lifehealthexamcoach.com. And understand that real world agent tip here is clients often confuse universal life with whole life because they both build cash value. So again, universal life, flexible premiums, whole life, fixed premiums. It's the biggest difference. So when is UL policies appropriate? If you need premium flexibility, if you need fixed guarantees, maybe not. If you think you need term, you need more coverage, might be better to go that way. If you need permanent coverage or you have a goal that aligns with permanent coverage, maybe ULs would work. So advantages, again, premium flexibility, adjustable death benefit, cash value accumulation, potential for higher credit interest and guaranteed minimum, and lifetime protection if sufficient policy value supports coverage, okay? Disadvantages, policies can lapse if poorly designed, requires ongoing monitoring, interest rates fluctuate, policy performance depends on a lot of variables like premiums paid, policy charges, and credit and interest, and insurance costs increase with age, okay? So for the exam, big takeaways here. First of all, highest priority is to understand UL policies, universal life, have flexible premiums. They have adjustable death benefits, interest crediting, minimum guaranteed interest, cash value, and big high priorities is policy lapse rates, okay? They're an unbundled policy, okay? They appear frequently on state exams. So remember, universal means flexible. It's like universal is everything. Flexible is like, you got space to move around, right? So that's the memory trick. If you can change almost everything, you're flexible, like premiums, death benefit, payment, but you got to monitor the policy. That's the big thing. All right, some practice questions here. Number one, a universal life policy owner stops paying premiums. When will the policy remain in force? Never. Only if dividends continue, as long as the cash value exists to cover policy charges, or only for 1 year. The answer is C, as long as the cash value exists to cover policy charges. That's because universal life stays in force as long as cash value exists to pay monthly policy charges. But once it's exhausted, additional premiums required or the policy lapses. Okay. Why the other choice is wrong. Never is just incorrect. The policy can remain in force without premium payments. B, only if dividends continue is incorrect. Universal life doesn't pay dividends, it credits interest. And D, only for a year, that's incorrect because there's no fixed 1 year grace period tied to cash value. Practice question 2, what best distinguishes universal life from whole life? Temporary insurance, flexible premiums, no cash value, or annual renewable term. The answer is B, flexible premiums. That's just a feature of universal life, whereas whole life has fixed premiums. Temporary insurance is term insurance. Both plans, universal life and whole life, have cash value. And then annual renewable term is a term feature, not with permanent coverage. Practice question 3, universal life policies credit cash value using stock market ownership, mutual fund performance, interest declared by the insurer, subject to merit guaranteed minimum, or dividends only. The answer, of course, is C, because that's just what they do. They credit interest declarations. You don't own stock in a universal life plan. There's no mutual fund allocation. These are variable life or variable universal life plans. And dividends are paid out with whole life plans. So again, fast facts here, wrapping this up. Premiums are flexible with universal life. Cash values, interest credited by the insurer. Death benefit is usually adjustable. Risk is that the policy can lapse because of all of these little variables you got to monitor. Keyword on the exam is unbundled policy. And remember, flexibility requires monitoring. So that's the summary today. We've learned all of this stuff. And remember to download the slides at lifehealthexamcoach.com for free. In today's lesson, we're going to talk about variable universal life, which is flexible premiums plus investment control. So if you're practicing for the life and health insurance exam studying, then this content's going to be really good to help you clarify and demystify the sometimes confusing subject matter. So first of all, our objective today is to learn what variable universal lives, I'll call them VULs for short, is, describe investment options within the policies, explain the risk that policy owners carry with these plans, understand premium flexibility, explain securities regulation, and then compare VUL to other permanent products. So let's define variable universal life. It is a permanent life insurance policy that combines flexible premiums, an adjustable death benefit, investment-directed cash value, separate accounts, that's a big one, and a securities regulation. So again, when you think universal life, it's universal life plus variable investing. It's really how to think about it. And that's variable universal life. So my notes here, again, universal life insures, earns interest, okay? Whereas a variable universal life owner chooses the investments. And every feature of universal life still exists. The difference is who chooses the investments, okay? So how do VULs work? First of all, premiums are paid to the policy. Insurance charges are removed. Cost of insurance and fees are deducted. The remaining premium is put into separate accounts, and you choose those. And then there's an investment performance component with it. So market goes up or down. The losses are applied. The cash value changes because of that. And the death benefit may change as well. So the key point is that the policy owner chooses investments, but the insurance company does not guarantee returns, okay? So there's separate accounts with this. So what that means is that you can put this money into stocks, bonds, money markets, international funds. You can balance it out. You can do index funds, and the options vary by insurer too. So separate accounts are not part of the insurer's general assets. They're subject to market performance and owned for benefit of the policy holders, okay? So as far as a tip goes, separate accounts are a hallmark of variable product. Like that's the thing that makes them variable in some sense. So there's also premium flexibility, so you can skip, reduce payments, adjust them up or down anytime, and increase or pay more if you want to enhance the funding capability. So in good markets, cash value grows, premium flexibility increases, but in poor markets, cash value shrinks and additional premium may be needed. So however, poor investment performance may require higher future premiums as well. So if you design this poorly, you may be in a problematic situation as well. So an example would be a bull market where premium flexibility increases. That means your cash value grows. And then a bear market is the opposite. Cash value declines. So real world example, you put $200 a month. You have 3 years of poor performance, and then $350 a month because a premium increase is required because of the poor performance. That could happen. So you also have an adjustable death benefit with VULs. You have the option A, which is a level death benefit, and an option B, which is the increasing death benefit, just like in a UL. So memory clue left, option A is level death benefit. Death benefit A is level, cash value grows inside of the policy. And B, right, increasing death benefit, meaning the death benefit increases as cash value grows. So the policy owners may change options subject to underwriting and policy rules as they go through it. So who bears the investment risk? This is the big thing that you have to understand. It's not the insurance company, it's the policy owner. They bear all of the investment risk, not the insurance company. Investment gains and losses belong to the policy owner. And in a VUL policy, the insurance policy or insurance company bears none of the investment risk. So if the investment increases, cash value increases and potential death benefit increases. But if it decreases, cash value goes down, death benefit may decrease, and more premium may be required to keep the policy in force. So remember, the insurer never guarantees investment performances with a VUL, variable universal life plan. Also, you need to have securities regulation here. This is not like most other life insurance products. You need to have a life insurance license, a securities registration, a prospectus delivery, which involves FINRA and SEC oversight. So you may not ever sell this if you never become securities licensed. So generally, agents need a life license and securities license to make it happen. And the policy includes prospectus, investment disclosures, SEC oversight. And variable products require both insurance and securities license to sell. Advantages include potential for investment growth at higher rates, tax-deferred cash value, premiums that are flexible, adjustable death benefit, permanent protection, wide investment choices, and tax-deferred cash value growth. So a lot of the benefits that come with universal life plans with some of these upside investment opportunities that come along with some risk as well. Best used for investment-oriented clients, high-income buyers, and the goal for long-term accumulation. So potential drawbacks include investment losses. There's no guarantee that you're going to always go up in the value. There's higher fees. That's something that is buried into the plan. They cost more. There's more complexity. There's possible lapses like regular ULs if underfunded and not managed right. There's no guaranteed cash value growth, and policy performance must be monitored, just like any UL. So again, quick recall here. Variable means investment risk. Universal means flexible premiums. Variable universal life means both. So a trick to help you memorize on the exam. Universal means flexible premiums with insurer credits interest. Variable means investment risk in separate accounts. And variable universal life means flexible premiums, separate accounts, and policy owner bears the investment risks. This is not ideal for risk-averse clients, clients wanting guarantees, and people unwilling to monitor investments. That's a lot of people. So here's the comparisons of VUL versus variable life. You can take a look on the screen here and do this comparison. You can download the slides at lifehealthexamcoach.com for free once you register. Remember, variable universal life is more flexible. Here's VUL versus universal life. You'd like to take a look at the difference there. Exam shortcut here is to remember universal life, it credits interest, whereas VULs, the owner controls the growth. So common exam questions. Who bears the investment risk with VULs? It's the policy owner, not the insurance company. Exam traps, remember these, okay? All of the differences here, very important to understand. Only variable products transfer risk from the policy owner. That's the big thing, to the policy owner. So where is cash value invested with a VUL inside of separate accounts? Is cash value guaranteed? No, it is not. It can't be because of the nature of the risk. Does VUL require security license to sell? The answer is yes. And are premiums flexible? The answer is yes. It's a universal life plan, and all universal life is flexible. So a memory trick here again, variable means investment risk, universal means flexible premiums, variable universal life means both. We like repeating these concepts so that you'll remember, okay? So think of the name as a formula. Variable adds investment risk, universal adds premium flexibility, and the combination of both makes both happen. So here's your formula again if you need it one more time. And then here's a real world example. Sarah purchases a $500,000 VUL. She contributes extra premium. She allocates 60% to a stock fund, 30% to a bond fund, and 10% to the money market. 10 years later, if the markets perform well, she has higher cash value and growth potential and a higher death benefit. If there's a bad market, there's lower cash value and possibly the need for additional premiums. So again, this is kind of a real world example of what it could look like as far as growth goes relative to a bad market and a good market, just to show the differences. So practice questions. A variable universal life policy differs from variable life because it guarantees investment returns, has flexible premiums, uses the insurer's general account, or eliminates investment risk. Let you think about that for a second. The answer is B. Flexible premiums are the major difference. Why? Because flexible premiums are the defining feature that distinguishes VULs from variable life. Both carry investment risk, but only a VUL allows premium adjustments. That's the big difference. Okay? Next question. Investment gains and losses in a variable universal life policy affect the insurance company's profits, policy owner's cash value, state guarantee funds, or policy loans only. The answer, of course, is B. Investment performance directly impacts cash value. Why? Because VUL cash value is held in separate accounts and invested in market-based funds, and those gains and losses flow directly to the policy owner. Slide 19. Practice question 3. Variable universal life policies invest cash value in general accounts, fixed accounts, separate accounts, or reserve accounts. The answer here is C, because what you have to understand is that separate accounts are the defining investment feature of variable universal life products. Okay. Know these cold as we wrap this up. VULs have flexible premiums, adjustable death benefits, separate accounts. The policy owner bears the investment risk. There's no guaranteed returns, and they require a security license to sell. And if you know these 6 facts, you'll probably do just fine on your exam. In today's training, we're going to specifically teach you all about index universal life insurance, probably the hottest and most talked about life insurance product, talked about and sold in the current year. And more specifically, that we're going to help you not just understand it, but to help you know enough about it to pass the questions on your life insurance exam that you're about to take. So by the end of this lesson, you're going to understand how universal life fits, IULs fit into the universal life family. And you're going to see that they have a fixed interest rate, which is more predictable. Index-linked growth for floor protection, and how VULs are different. And you'll kind of know exactly how everything fits, okay? So that's the goal. So why was IULs created in the first place? So understand that Index Universal Life was developed to bridge the gap within the universal life family between stable fixed interest coverage and then policies that have market-linked growth potential. So, we have variable universal life. That's the lesson we just did. We have fixed universal life. And there's pros and cons to both of those, right? And so what Index Universal Life allows is a middle ground where there's more growth potential than just the standard UL, with downside protection through index crediting features, which are called floors, and while VULs offer the highest growth potential and the highest market risk. So this is kind of that mushy middle, like kind of compromise that give you a little bit of the goods on both sides. So what is Index Universal Life? So it is permanent life insurance. It has a flexible premium. You can adjust the death benefit, and it has cash value. The big difference is that interest is tied to a stock market index that you'll be credited on. So understand that flexible premium and adjustable death benefit are frequently tested. Know that IUL allows both, unlike whole life that only has fixed premiums and a fixed death benefit. Also understand the policy does not invest directly in the market. As an IUL policyholder, you do not own stocks, ETFs, mutual funds, or shares of an underlying index. You're credited on those, okay? So the definition most commonly tested is permanent plus flexible premium plus the adjustable death benefit plus cash value plus index-linked interest. So the insurance company uses an index like the S&P 500 is very common as a formula for calculating interest credits. So cash value growth is linked to the index's performance through a crediting formula, not direct ownership of investments, okay? If it was direct ownership of investments, it would be a variable universal life plan, okay? Now, index does not mean invested. This is a core licensing concept. You'll see this happen on the exam all the time. Students often confuse index-linked crediting with direct market investment. The policy owner does not own stocks, ETFs, mutual funds, or shares of an index. So if you have a direct market investment, and by directly in S&P 500 ETF, you can drop 15% and have your value drop by 15%, okay? Whereas in an IUL policy, the policyholder does not own stocks, ETFs, mutual funds, or shares of an index, and the policy simply receives an interest credit calculated using the index performance. And it's protected by a floor. So if the S&P drops 500, or excuse me, S&P 500 drops 15%, they'll get 0% interest credit, which is not a loss due to the policy's floor. So the uniqueness of this is that it potentially eliminates downside risk. Pretty cool, huh? So they also have a spread rate, which is a percentage subtracted from index gains before crediting. So the key thing here is indexed does not mean invested. The policy owner never owns an index component. So how is interest credited with Index Universal Life? So let's do the cash value flow. So the premium is paid, the policy is charged, there's cash value. Then there's an index formula which determines the interest credit. So interest is generally credited periodically, like annually, according to the policy selected indexing method. The insurance company may use the S&P 500, NASDAQ, Dow Jones, proprietary index. There's all sorts of options depending on the companies you work with. And this crediting formula may include a participation rate, a cap rate, a floor, or a spread rate depending on policy design. Again, I repeat, the client owns no stocks, ETFs, mutual funds, or index shares. Interest is calculated only from the chosen index's performance. And the interest is calculated using index performance via formula. Again, never through direct investment. I'm trying to beat this into your head. This is not an investment product. IUL is insurance. And this is part of the reason why. Okay. Here's the three most important concepts with IULs. First is a participation rate. This is how much of the index gain counts. So here's an example. If the index gains 10% and you have an 80% participation rate, you get 8% credited. So your slice of the index gain is the participation. Okay. The cap rate is the maximum amount of interest allowed. So let's say your index gains 18%, but you're capped at 10%. So your ceiling is 10%. You're not going to get more than that. That's your ceiling on your gains. There's a floor and there's a ceiling. And of course, number three, floor, minimum credited interest. If there's a loss of 15 and a floor of 0, you have 0%, not a negative credit. Okay. So a spread rate is the percentage subtracted from the index gain before interest is credited. It's used in some IUL products instead of or in addition to caps and participation rates. So understand participation rates, cap rates, and floors are the frequently most tested IUL crediting concepts on the state license exams. It's important you understand this. And many IULs protect against negative index returns with a floor, often 0%, while limiting upsides through caps or participation rates. So in a kind of way to think about it is in exchange for protecting from downside loss, there's big win years, you may not participate entirely with caps and floors or caps and participation rates. So here's kind of how it would look if you're in a year where we have an index return versus an interest credit IUL. So if it's 4%, again, you got the participation of 100%, cap at 10, floor at 0. So here in year one, both the index and like your investment in your stocks, there's both 4% credit, 8% since it's under 10% credit. Now the 12% cap, because there's a cap of 10, your IUL only gets 10, whereas your stock investment gets 12. Now, if you have a 20% year, yeah, your stocks get 20, but you still get 10 in your IUL. And then down here at the bottom, again, to compare and contrast, you lose 5% of your value in your stocks, but there's a floor of 0, so you have no loss credited. And then you have a terrible year of losing 18% in your stocks, but your IUL credit's 0. So there's no downside risk. Okay. So the credited interest tracks the index 1 for 1 until 10% cap is reached, then it flattens. When the index is negative, the 0% floor prevents negative interest credits. Okay. So caps restrict maximum gains regardless of index performance, and the protected downside floor ensures clients never receive negative interest credits. Flexible premiums do still apply. So like all UL plans, you have flexible premiums, adjustable death benefits, cash value accumulations, policy loans, and withdrawals. And understand that poor funding can cause these policies to lapse if cash value cannot cover ongoing policy costs. IUL performance is not guaranteed beyond contractual minimums, so adequate funding and monitoring matters. This is kind of the big thing with IULs and any ULs. You have to watch it. Can't set it and forget it like whole life. So flexible premium and adjustable death benefit are key features that distinguish UL policies from whole life, commonly tested on the exam. So what are some advantages of IULs? So some clients love it because it has a potential for higher cash value growth than fixed universal life. Okay. There's downside protection, no direct stock market losses. That's a huge motivation. There's tax deferred growth. The cash value grows tax deferred. And there's policy loans, which are possible tax advantage access to cash value structured correctly. And they have flexible premiums, which can increase or decrease the payments within the policy limits. Again, all things have downsides. So what are they with IULs? Returns are limited because of the caps. You can't exceed the caps. The policy expenses include insurance costs that increase with age. If it's not properly designed, you can have a lot of the problems that were talked about in the universal life section. They are more complicated, kind of harder to understand than whole life, can kind of like gloss over people's eyes if you're not really good at simplifying the complex. And performance is not guaranteed. Okay. Interest depends on index performance and policy crediting rules. So things like caps, participation rates, and spread rates are not fixed for life. Insurers can change them periodically, subject to contractual guaranteed minimums stated in the policy. And poor funding, if it's not funded right, can cause the policy to lapse, especially later in life. So here's two clear side-by-side comparisons showing how IUL differs from whole life and variable life insurance. You can take a look at the difference here. You can download these slides at lifehealthexamcoach.com. That's my website. Once you register, it's free. You can get this and use these to study. So some licensing exam tips. The distinction is commonly tested on exams. So again, suitable clients. An IUL may fit for people who want permanent coverage, flexible premiums, cash accumulation, some growth potential, less investment risk than a VUL, because those are separate accounts where the insured can participate in gain and participate in losses. But it's not ideal for guaranteed cash values if that's important to you. If you're just like you're just like want to approach this simply, there's a lot of moving parts with IUL, so just proceed with caution. And if you have short-term insurance needs, just like with something a temporary plan like term would do, maybe better. So these are the most commonly tested IUL facts on the exam. Again, know that IUL is permanent with flexible premiums, adjustable death benefit, cash value, index-linked interest, not directly invested in stocks, uses caps, uses participation rates, uses floors, and yes, policy loans are available. Let's talk about some common exam traps, okay? A question. A client purchased an index universal life policy tied to the S&P 500. Who owns the underlying stocks? Is it the policy owner, the insurance company, mutual fund, or no one? The policy simply uses the index to calculate interest. The answer is D. The policy does not invest directly in the stock market, neither does the insurance company or the mutual fund. Practice question 1. This is the simplest cap-only scenario. So an IUL has a 9% cap and a floor of 0. The interest gains 14%. How much interest can be credited? 14%, is it all of it? Is it 12%? Is it 9% or 0? The answer is C, because again, the cap tells you if anything, you can't be credited anything in excess. So if the index is in excess of the cap, then the credit equals the cap. Big calculator on the screen. We use that a lot. So a little advanced calculation here. A client's IUL has a participation rate of 75%, a cap of 9, and a floor of 0. The index gains 16% this year. How much interest can be credited? So first of all, you got to apply the participation rate. The index gain of 16% is multiplied by the 75% participation rate. So that's 12%. Okay. Then apply the cap rate. So the calculated interest rate exceeds the 9% cap. Therefore, the interest credited to the policy will be limited to 9% cap. So select the right answer. The right answer is C. Okay. So again, the cap is still the cap. And so even with all the extra math, that's all you get is the cap. Practice question 3. The index universal life cash value growth may be tied to a market index, but is not directly invested in the market. Which statement is true regarding IULs? Cash values invested directly into stocks. Premiums are fixed forever. Cash value growth may be tied to a market index, or D, death benefit expires after a stated term. Answer C, is tied to a market index. Okay. So some key takeaways here in this lesson. IULs are permanent insurance. They're index-linked interest. No direct investment in stocks. There's cap rates to cap the gains that you get credited for. There's a floor to prevent your gains from dropping negative, and a flexible premium so you can adapt the premiums over time. Welcome back to our deep dive training. And today we're going to be specifically learning adjustable life insurance so that you can practice and pass your life insurance exam. So what you're going to learn today is exactly how adjustable life works regarding its premium, death benefit, cash value, and payment period. Bottom line, adjustable life is a flexible, permanent policy, but it's not the same as universal life. These are commonly compared, so it pays to know the difference. So you'll be able to, by the end of this, define adjustable life, identify the policy features that make it such, explain how adjustments affect premiums and cash value, recognize situations where adjustable life is appropriate, avoid confusing adjustable life with universal life, and identify ideal candidates, including growing families, small business owners, and those changing income. So as an exam warning, increasing the death benefit generally requires evidence insurability. This is one of those most tested concepts on state licensing as it relates to adjustable life insurance. So let's talk about what adjustable life insurance is. It is a policy that is one policy, not two. It's a permanent life insurance plan with built-in flexibility. The adjustable life combines permanent protection of whole life with the flexibility commonly associated with term insurance. So understand it's not a combination of two separate policies, it's one and the same. So in other words, think about it as adjustable means flexible. As life changes, maybe there's a marriage, children, mortgage, or you just have to adjust the policy because life evolves, the policy can be modified instead of replaced. So think it as one permanent policy that can evolve with the insured. And understand that increasing the death benefit generally requires evidence of insurability because that's one of the features that are in there that may cause for more underwriting. So adjustable life combines two concepts, whole life, term life, which blends together to make adjustable life. So again, don't confuse the features of whole life and term with the meaning of the policy as part of whole life and part term. It's one permanent policy with adjustable features. Okay. So many licensing exams describe adjustable life as combining features of whole life and term. So Dave, what can exactly be adjusted on an adjustable life insurance policy? For four core elements can be adjusted, including the premium, death benefit, premium payment period, and the policy duration maturity. Remember that lowering premiums may require reducing the death benefit or extending the premium payment period. An existing cash value is not lost simply because adjustments are made, although some changes require evidence of insurability. So let's talk first about increasing the face amount. If the owner ever wants more insurance, they can request an increase, and evidence of insurability is required, which requires underwriting, and then it's approved at a higher death benefit and a possible higher premium. Understand that increasing the death benefit generally requires evidence of insurability. And this is, again, the number one most tested concept about adjustable life on state licensing exams. So I repeated it a bunch already because it's that common. Okay. All right. So decreasing the face amount, you can do that too. That lowers the premium. You get less coverage. The insurer acts to process a reduction. No evidence of insurability is necessary. And then you get less coverage. Okay. So you can always lower it, and it may reduce the death benefit or extending the premium payment period. So existing cash values not change during the adjustment, and evidence of insurability isn't required either. Premiums may be adjusted as well to change to fit the owner's budget. So higher premium means greater cash value accumulation. Lower premium means lower cash value growth, which may require reducing the death benefit or extending the payment period. So reducing premiums too much may eventually cause the policy to lapse if insufficient funds and cash value exist. So existing cash value is not lost simply because premiums are adjusted. Just keep that in mind for the exam. So cash value does continue to grow. It remains permanent insurance. So there's cash value accumulation, tax deferred growth, policy loans available, and cash surrender value available. And remember, adjustments to premiums or death benefits do not eliminate cash value. Cash value grows as long as the policy remains in force. So adjustable whole life versus adjustable life versus whole life. Go ahead and take a look at that chart. Remember, you can go to lifehealthexamcoach.com to download these charts for free if you need more study guides, okay? So adjustable life, in short, is more flexible than whole life, but less flexible than universal life. So the comparison between adjustable life and universal life is just more flexibility, okay, than for whole life. With universal life being the most flexible, whole life being the least flexible. So adjustable life, right in the middle, okay? Advantages include adapts to changing needs, coverage can increase or decrease, flexible premiums, permanent protection, cash value accumulation, and no need for new policy. The drawbacks include more complex and whole life, increasing coverage needs evidence of insurability, reducing premiums too much may cause a policy to lapse, and then lower premiums reduce cash value growth. Remember that improper adjustments may reduce cash value, that's important, or cause the policy to lapse. And they're a bit less predictable than whole life insurance, okay, because of these flexibilities. So it works well with people who have growing families, a mortgage, retirement, children independent, becoming independent, rising income. If you just need flexibility in your insurance, it can make sense, okay? So to know what do you need to know for the exam? So these are the highly tested facts that come up a lot. It's permanent insurance that builds cash value. Adjustable life is premiums and death benefit can be adjusted. Its increasing coverage always requires evidence of insurability. More flexible than whole life, but less flexible than universal. It combines features of whole life and term. That's very important. Screenshot this, download our slides, memorize it based off of this. So let's hit some practice questions. A policy owner wants to increase the death benefit on a policy life, adjustable life policy. What's required? Would it give the advice away already? Increasing the death benefit generally requires the evidence of insurability. Put the answer before the questions. So evidence of insurability. So there you go. Whoops. Practice question 2. Which characteristic best describes adjustable life? Fixed premium and fixed death benefit, temporary insurance, permanent insurance with adjustable features. There we go again. Or is it a trick? And no cash value. So the answer is C, of course. So just note that it's permanent insurance with adjustable features. Question 3. Which policy generally provides more flexibility? Whole life, adjustable life, universal life, or term life. So universal life is more flexible than adjustable, which is more flexible than whole life. Okay. So the key takeaways here are adjustable equals flexible. It's permanent insurance, and an increase in coverage, if you haven't learned already, means evidence of insurability required. In today's training, we're going to talk about joint life insurance or first to die policies. Very important that you understand how this works. Specifically, you're going to learn how joint life works, how first to die policies work, its common uses, advantages, and disadvantages, what the difference is from survivorship or second to die policies, and then how the state licensing exam approaches these questions. And the focus will be knowing exactly when the death benefit is paid, because that's what the exam likes to test on. So what is joint life insurance? It's one policy with two insureds. Joint life insurance covers two people under one single life insurance policy. So usually it involves business owners, business partners specifically, married couples, or individuals with shared financial obligations. And like two separate policies, there's only one death benefit that's available. So one death benefit, two people on one policy. All right, remember that. That's very important. Okay. So what is first to die? So it's a death benefit that pays after the first death. So when either of the insured parties die on the joint plan, the death benefit's paid. The policy terminates, and there's no second death benefit later. It's first to die gets the money. The surviving insured receives no further life insurance protection under that policy unless additional provisions allow continued coverage. So remember, the policy ends after the first death benefit is paid. The surviving insured is not automatically covered. So the timeline here, policy starts, spouse dies, death benefit paid, policy ends. So why would somebody buy one? Common financial need is protecting the survivor. So things like a mortgage payoff, income replacement, family living expenses, shared debt, children's education. The surviving spouse receives money immediately after the first death. So we got John and Sarah, mortgage, 2 kids, dual income. John kicks the bucket. Insurance pays Sarah. The mortgage is paid off and the income is replaced and the policy is done. So also, this is where it's really most commonly used is inside of business situations where business owners will often purchase a first to die plan, and it's predominantly used to fund buy-sell agreements. Okay, so it provides cash to buy the deceased owner's share of the business. So if there's two parties, one of them dies, the financing is made available, and it's used to buy that portion to pay the family off. It creates a market to sell ownership of the business, keeps the business operating smoothly as well. And instead of needing multiple policies, one joint policy may satisfy the funding need. So also understand that some buy-sell agreements may be funded with first-to-die policy, although many businesses use cross-purchase or entity-owned arrangements instead. So it's another option. So again, partner A dies, insurance pays. Partner B is obligated legally to buy the interest rate with a contract, pay it off from the survivors, and then the business continues. So why choose a first-to-die plan? It typically is a lower cost because it pays sooner than later, and it's less expensive than two permanent policies. So one policy, one premium, one contract. There's immediate protection. It provides money exactly when the surviving family members need it the most, and it covers those shared obligations very well. Important drawbacks with these plans: there's only one death benefit, not multiple. Surviving insured may need new coverage, so it may be in those cases inappropriate, and less flexibility than two separate policies. Okay. So insured A person can be labeled insured A, person B can be insured person B. Death occurs and triggers claim for the first death, and then one death benefit is paid and the policy ends. So first to die versus two individual policies. This is the chart if you want to check it out. Again, joint first to die ends after the first death. That's the key thing. You can print this chart off, find it, screenshot it. You can go to lifehealthexamcoach.com to download it for free too, along with our other training. Again, lower cost often means fewer benefits as well. So first to die versus second to die. So first to die plans pay after the first death. Second to die pay after both deaths. Okay. So it's just when it occurs. And these are the differences where you would need it. Mostly in the second to die, it's a protection for heirs and estate planning, estate liquidity, and continues after the first death. So first to die protects the survivor. Second to die protects the estate. And again, this is just a memory aid. So some licensing exam tips. Remember, they cover two insureds with one contract, one death benefit, and it pays after the first death, and policy ends after the first payment, used for couples, business partners, and shared debts. So many students confuse this with survivorship life. It's timing of the death benefit that's the key distinction here, okay? So some practice questions. A joint first to die policy pays the death benefit. Is it after both die, after policy maturity, upon the first insured's death, or the probate? The answer is C. A joint first to die policy pays upon the first insured's death. A joint first to die plan is commonly used for estate planning, income replacement, charitable giving, or at creating inheritance. The answer is B. Income replacement for surviving spouses is the most common usage. Question 3, after a joint first to die plan pays its death benefit, coverage continues, another death benefit remains, policy usually terminates, or premiums increase. The answer is C, because after the death benefit is paid, a joint first to die plan generally terminates. So summarizing here again, joint first to die plans covers two people, death benefit paid at the first death, and it ends after the first payment. Used for family income protection, mortgage and debt protection, and sometimes business buy-sell planning. It has lower cost than two separate permanent policies. And a first to die pays at the first death, second to die pays after both deaths. So exam shortcut, again, sorry you can't see this very well. First to die protects the survivor, second to die protects the estate. Make sure you understand both. In today's training, we're going to talk about survivorship life insurance, or what's known as second to die life insurance. This is very important because it has estate planning protection contingencies regarding two lives. And the goal here is to understand how it works, how it differs from first to die coverage, its primary estate planning uses, and how it's going to appear on the state exam. It will show up. So what is survivorship life insurance? It's a policy that covers two insureds under one policy. It pays one death benefit, but only after both insureds have died. It's commonly called second to die or last survivor insurance as well. And most commonly, it's going to insure two spouses, but it can also cover business partners or family members. So if you look over here on the right, insureds covered, two insureds covered under one policy, one death benefit paid after the first death. Okay, benefits paid after the second death, excuse me. So again, first death, no payout. And yes, the death benefit is zero benefits after the first death benefit, excuse me. And the second death benefit is when the benefit pays. Again, this is the number one common exam test question you're going to see. So make sure you know that the distinction. So this is how it looks. Two insureds, first death, policy continues, second death, then the beneficiary is paid. So their premium factors rate the ages of both insureds, the health of both insureds, a face amount, and the policy design is almost always permanent, typically a whole life or universal life plan. So it's one combined premium payment. The policy remains in force after the first insured dies. The premiums are typically required to continue after the first insured dies, unless a waiver of premium rider is included. And at the second death, the full death benefit is paid to the named beneficiary. So these are the differences between first to die and second to die. You can download this at lifehealthexamcoach.com if you want more information. And you get this for free with flashcards, exam questions you can test yourself on, and more. Common uses for in estate planning applications. So this is commonly used to pay estate taxes to avoid forced asset sales. wealth transfer to heirs, equalizing inheritance among multiple heirs, the fund what's called an irrevocable life insurance trust fund, a business succession planning, as well as special needs planning too, so that fund a trust for a dependent. It works well for estates because large estates face liquidity issues and needs at death, and insurance provides immediate cash on hand to take care of those. And it avoids having heirs having to do fire sales to sell property like businesses, homes, etc., to pay taxes. And this is how it looks ultimately as it is done. Advantages and disadvantages: lower premium than two separate permanent policies. That's an advantage. It's easier to qualify for because joint underwriting is used. So the policy may be issued even if one is uninsurable or in poor health. And permanent coverage means policy does not expire, so ensuring the benefit will be paid. Disadvantages mean no death benefit paid at the first death. Survivor gets nothing. It's not suitable for income replacement needs because if the first one dies and you need an income replacement, it's not going to work until the second person dies. It's not appropriate for young families with temporary needs. And if a couple divorces, policy complications may arise. So survivorship life is not an income replacement tool. It's an estate planning tool. Okay. If a question ever represents something along income replacement, it's the wrong answer. Survivorship life is not the right answer. So most tested facts about this include pays only after the second insured, covers two insureds, one death benefit, predominantly used in estate planning and wealth transfer. There's a lower premium than two separate permanent policies. The death benefit is generally income tax-free to beneficiaries, and it's often held inside an irrevocable life insurance trust. So the exam may describe a couple wanting income protection after one spouse dies. That's first to die, not survivorship. Survivorship pays only when both have died. So when do you recommend a survivorship life insurance plan? It's with clients of super high net worth couples with large estates. They need to cover estate taxes at death, maybe business partner succession funding. Family wants a trust fund or special needs dependent. Client wants to equalize inheritance among heirs. Don't recommend when there's income replacement after one spouse necessity. Young families don't need this. Client cannot afford to wait until the second benefit, and the couple is just divorcing or separating as well. Okay. So let's do an example. So John and Mary own a large family farm worth $3 million. They want their three children to inherit the farm without being forced to sell it to pay estate taxes after both parents have died. Which policy is most appropriate? 20-year term life, joint first to die, survivorship second to life die, or universal life single premium? The answer is C, because the benefit is needed only after both parents have died, and the purpose is estate preservation, not income replacement. Okay. Practice questions. A survivorship policy pays at the either insured's death, at the policy maturity, after both have died, or at retirement. The answer is C, after both die. Survivorship policies are most commonly used for temporary income replacement, estate planning, mortgage payoff, or child education. The answer is B, estate planning. That's the big thing. Question 3, compared with a joint first to die policy, survivorship life pays sooner, pays after the second death, covers one person or has no beneficiary. The answer is B, it pays after the second death. Okay. So in short, what are the main things you need to know? Survivorship second to die plan covers two insureds, pays one death benefit after both have died. It's used in estate planning, not income replacement. It's a lower cost than two separate permanent policies and easier to qualify for. And survivorship is almost always a permanent plan, not a term product, and most commonly compared with joint first to die on the licensing exam. So know the difference. Okay. In today's lesson, we'll be talking about juvenile life insurance, understanding life insurance designed for children to help you pass your life insurance exam. So without further ado, let's begin. So we're going to be learning exactly what juvenile life insurance is, who owns the juvenile life policy, why parents purchase it in the first place, and understanding things like guaranteed insurability riders, how they can be useful on kids' plans, and recognizing those exam traps, because that's the whole point of this, is to help you pass the life insurance exam. So first of all, why does juvenile life insurance actually exist in the first place? So many people assume kids don't need life insurance. Why would they have a policy to begin with? Well, the insurance industry disagrees because lots of people like it and buy it for their kids. So juvenile life insurance is designed to guarantee future insurability, very important, lock in low premiums, they're very inexpensive, at that age, begin building cash value if they appreciate what permanent policies provide limited death benefit protection, and provide funeral expense protection too. It's not designed for an income replacement strategy by any stretch. It's designed for the reasons mentioned previously. So juvenile insurance is just life insurance written on the life of a kid, usually from birth to around 14 to 17, depends on what the insurer will accept. The insured is the child, and the owner is usually a parent or grandparent, excuse me. So again, the parent owns, the grandparent or parent pays the premiums, the child is insured, there's a death benefit, and eventually one day an ownership transfer. So know the difference between an owner and an insured. The owner is the person who controls the policy, pays the premiums, they can change beneficiaries, can borrow cash value on the plan, and at any time surrender or transfer the policy. Insured, of course, is the child. That's the life that's covered by the policy, and the underwriting is based on the kid's age and health. Has no control over the policy until it's transferred over. So understand this is where owner and insured are typically tested. Know the difference, especially for a juvenile policy. So again, all of this depends on your age. Again, if you're 1, the premiums are a lot lower than you're 45. All right, so the younger is the insured at issue, there's a lower mortality risk, which means a lower premium. And on whole life, those premiums remain level for life, so they can be really good. There's also a guaranteed insurability rider. So if a kid ends up developing things like cancer, diabetes, heart disease, multiple sclerosis, and you can have without a medical exam or evidence of insurability, the coverage may be able to stick with them beyond that point. So understand, know this for the exam, that coverage may be purchased at specific option dates later and tied to age milestones or qualifying life events. So this is the GI rider in action. You buy the $25K whole life, the kid gets diabetes, and they have guaranteed insurability riders to purchase more coverage. So it's a nice little feature that sometimes can be provided. Permanent policies are the most common. We see whole life plans, sometimes universal life, almost never term life is used. Sometimes they don't even allow it in many cases. So on the exam, if they ask you what type is most common, just say whole life. Cash value growth, they do develop those because they're permanent plans. So you get guaranteed cash value, possible dividends, and policy loan features with future flexibility. And that cash value belongs to the owner of the policy. So the ownership transfer happens around adulthood. The parent owns the policy. The child reaches adulthood, and the ownership is transferred over along with the loans, beneficiaries, and changes. Okay. The death benefit is paid to whoever the named beneficiary is. Typically, it's the parents, and that's paid for things like funeral expenses, medical bills, financial hardship. And it's typically smaller than most adult plans, but it can provide some sort of meaningful protection. So these are the advantages and limitations. So we've got lifetime coverage, cash value, fixed premiums, death benefit guarantee, future insurability with a GI rider, potential dividends, and limitations are smaller amounts, but something's better than nothing. Cash value growth is slower, requires long-term premium commitment, and should complement but not replace existing financial plans. So this is the difference between juvenile and adult plans. Remember, you can go to lifehealthexamcoach.com to download these slides for free, along with flashcards, practice test, exam questions, and more. Link is in the description below. Juvenile life versus savings account. This is the difference here. Feel free to note that. Common misconceptions. Again, children don't need income replacements, or that the parents have to be insured, or child owns a policy, or juvenile policies are always term. The truth of on the exam that you'll be tested on is that purpose is insurability, lower premiums, and cash value, not income. Parents own the policy. They're not the insured. The parent or guardian owns the policy until transferred, and whole life is the most common for juvenile policies. So exam trap commonly we see is, why is juvenile insurance commonly purchased? Is it income replacement, retirement income, lock-in future insurability, or mortgage protection? And that is C, lock-in future insurability. Another one, who owns the policies? The kid, the insurance company, parent, or employer? Well, that's going to be the parent, C. The parent or guardian is the owner in virtually all exam scenarios. Which policy is most commonly used? Term, whole, variable, or credit life? Answer is whole life. And guaranteed insurability rider allows purchase of additional coverage after a medical exam, without a medical exam, only if healthy, only after underwriting. And the answer is without a medical exam, B. So real world example, parents purchase a $25,000 child whole life plan at 3 years old. The premium is super cheap. And at age 30, cash value is grown. The child remains insured and can purchase additional insurance without proving health if a guaranteed insurability rider is attached. So again, what you need to know for the exam is on the screen here. With a juvenile plan, the child is insured. The whole life plans are most common. Guaranteed insurability riders is a huge benefit. Parents own the policy usually. Cash value builds. The purpose is not to replace your income. So this is a visual representation of everything that we said to help you lock in and understand how juvenile policies work. In today's lesson, we're going to talk about group life insurance, passing the life and health insurance licensing exam. So we're going to go over what this is, how it works, such as master contracts, certificates, employer plans, and conversion privileges. This does represent a good bit of some of the questions related to life insurance policy types on the exam. So it pays to know the basics and fundamentals of group life insurance, which is why we're doing this. So by the end of this lesson, you should be able to explain how group life works, define the master contract, explain certificates of insurance, identify employer-employee responsibilities with the plan, explain contributory versus non-contributory plans, understand eligibility requirements, explain conversion privileges, and avoid the common exam traps. So what is group life insurance? Well, it's basically life insurance written under multiple insureds, which protects many employees under one policy. There is a sponsoring organization, so the policy is issued to the employer sponsor, and that has a master contract, which is a single policy covering the entire group. So it's not directly a policy to each employee. That's the most tested thing that you see here. If there's anything, remember that. So who owns the life insurance policy? The policy owner is not the employee. It's going to be the sponsoring party, which is the employer, union, association, or trust. And the employees are the insureds. Okay, that's tested a lot, so don't forget that either. So employer-sponsored coverage is the most common group life insurance policy. The employer buys, the employees are eligible, and then premiums are employee/employer shared. Okay, so they may be employer paid, employee paid, or a hybrid of both. So there's group underwriting, usually with no medical exam. So you don't have things like blood work, pee in a cup, individual underwriting, anything like that. And that's because the nature of a group is there's many people, so there's risk pooling. So healthy employees offset the unhealthy ones, and there's lower administrative costs that spread the risk. This is very tested, and it's one of the biggest advantages of group insurance because there's no examinations required. Sometimes underwriting is required. Typically, it's because there's late enrollment or there's coverage that's wanted beyond a guaranteed amount, or you're looking for supplemental coverage. So this is the exception if it's in these three circumstances where you would need evidence of insurability. So there is sometimes a waiting period or eligibility issues with these plans, like be full-time, complete a waiting period, meet minimum work hours, remain actively employed, okay? So an employee is hired, there's a 90-day wait period, and then coverage begins. This is very common, okay? So there are contributory versus non-contributory plans. So this is where the employee pays part of the premium in contributory, okay? Typically, participation requirements 75% or higher, which prevents adverse selection. And then a non-contributory plan is where the employer pays 100% of the premium, and then all eligible employees are automatically covered. This is tested a lot too. So again, this is just a visual representation of how it looks. Know this cold. And then coverage characteristics. Who chooses the beneficiary? The employee does, not the employer or the insurance company. The insured can select the beneficiary. And usually it's a flat amount of coverage equal to the salary, like 2x, 1x, 3x of the annual salary. So group term insurance is typically annual renewable term. There's no cash value. It's pure death benefit. This is heavily tested. So group life is term with no cash value. Advantages and disadvantages: it's super cheap, low cost, guaranteed issue, employer paid benefit, conversion privileges are available. You can payroll deduct, which is super helpful. The employees don't even have to cut a check for it. And it's super easy to enroll for. The disadvantages include it ends when the employment ends. There's very little customization. It depends on the employer relationship. There's no cash value and a limited death benefit amount. So this is how the conversion privilege looks. So there's a group life plan with no exam needed and some individual permanent conversion privilege required or optional. So conversion rules include the employee may convert regardless of health without proving insurability and within a limited time, typically within 31 days of quitting their job. So their employment ends, the conversion period opens, and then that policy converts to an individual permanent policy without an exam. So can someone who's seriously ill convert? Yes, because there's no medical exam or no health questions. That's the purpose of conversions. Very, very nice and very commonly tested. So after conversion, what changes? So typically the premiums increase because the individual coverage is not at the group rate discount. They're at an older age, and it may be converted to permanent coverage. So this is a classic licensing exam question. So just because you can convert it doesn't mean it's going to be exactly the same. So we have Sarah leaving her employer in this example. She has a diagnosis of cancer. She converts it. She still qualifies without medical underwriting, and her coverage continues without the employer. But all of this may change, like the amount of coverage, et cetera, or the premium. So know these false statements. They appear on every exam. The employee owns the master contract. That's not the case. The employee, they do not. The employer does. Employees receive the policy. False. The group life builds cash value. That is not the case. It's false. Conversion requires medical exam. False. And the employer chooses beneficiaries. That's false. The employee does. So some practice questions real quick. A group life insurance master contract is issued to who? Employee, beneficiary, employer, or insured. That's the employer. The employees receive a master contract, certificate of insurance, individual policy, or rider. The answer is B, a certificate of insurance with the group policies. Group life insurance generally requires full underwriting, blood work, medical exam, or no individual underwriting. The answer is D, no individual underwriting. A non-contributory plan has employees paying all premiums, employer pays all premiums, employees pay half, or participation is optional. The answer is B. A non-contributory has the employers paying all the premiums. A conversion privilege allows the employee to buy more group coverage, convert the individual to an individual policy without evidence of insurability, increase salary, or cancel the insurance master contract. The answer is B, convert without evidence of insurability. Most employer-sponsored group life insurance is what? Annual annuitable term is the answer there. Which statement is true? Group life builds cash value. Employees own the master contract. Beneficiaries are selected by employers. Or employees usually receive certificates of insurance. So we know that's from the last question. The answer is D. And contributory plans generally require approximately 75, 50, 75, or 25, 50, 75, or 100% participation. The answer is 75% participation. So these are the key takeaways here. Remember, you can download all of this stuff, these slides, flashcards, exam questions at lifehealthexamcoach.com. You're welcome to take a screenshot of this too as well, but this is a very good summary screen. Thank you so much for watching. In today's training, we're going to be talking about credit life insurance in order to prep you for the life insurance and health insurance exam. So let's begin. So what you're going to learn here about credit life today is what it is, how it works, who receives the benefit, how it's designed from a benefit standpoint, how credit disability insurance works, consumer protection issues, and common licensing exam questions. So this is commonly on the exam. It's not super dense in this portion of the life insurance policy types, but it is covered. So we want to hit on the major notes here and just kind of bang through this real quick so you understand the fundamentals of credit life insurance. So you're going to be able to explain how it works, identify the policy owner, why benefits decline, know who receives the death benefit, understand consumer protection rules, and then answer common state exam questions. So what is credit life insurance? It's designed to pay off a borrower's outstanding debt if the borrower dies because a loan is before the loans were paid. So instead of providing money to the family, this is the big thing, the policy pays the remaining loan balance. So things like auto loans, personal loans, installment loans, retail financing, and some mortgages, this is where a credit life insurance plan pays very well. So again, if you don't have this, the borrower dies, the loan balance remains, and the estate of the family may be responsible. But with credit life, the borrower dies, the insurance pays the remaining loan balance, and the debt is satisfied. So the beneficiary is the borrower, the insured is the borrower, the beneficiary is the lender or the creditor, okay? So if you finance a $30,000 vehicle and then you kick the bucket, the insurance company pays the bank, but the family doesn't receive the cash, okay? So for the exam, the beneficiary is a creditor on this policy, not the insured's family. There's a declining death benefit in many circumstances. As the policy is paid down, the death benefit goes down too as well, because the risk is going down. So for the exam tip here, the premium often remains level as the benefit declines. Coverage mirrors the outstanding loan balance. So the coverage goes down, mirroring the loan. The premium stays the same. Premium structure typically looks like this. There's a loan originated. The premium is added. Single premium is the most common tested form on the exam. And the borrower repays the premium as part of the regular loan payments. So for example, $25,000 auto loan, credit life premium is $450. The total finance is $25,450. So a single premium credit life is the most commonly tested premium structure on the licensing exam. Also credit disability insurance. So it pays off a loan upon the borrower's death for life insurance, but disability is when you become disabled, and it covers loan payments only, not total income replacement. Okay. There are some consumer protection rules just to be aware of. Coverage is optional. You don't have to buy this. The borrower cannot be forced to purchase. Clear disclosure of the cost in the purchase process and financing process. Maximum coverage cannot exceed the loan balance. And then coverage ends when the debt is paid. So understand, for the exam, credit life is optional, not required. Advantages: it protects your family from inheriting debt. It's easy underwriting, simple underwriting, convenient enrollment, and immediate protection. The downside: it's often more expensive than comparable individual term life insurance that you may purchase on your own. The benefits decline over time. Benefits not even go to your family. And the coverage just is a debt protection. This is the difference between credit life and individual life. Remember, you can go to lifehealthexamcoach.com and download all of these slides, flashcards, and exam test questions, and more. So this is just a real life example. $40,000 automobile. She gets credit life insurance. She dies 2 years later. The remaining balance is paid off by the insurance company, and they receive the vehicle free of that loan. Okay. Common licensing questions: who's the beneficiary on these plans? The creditor, the lender. Who's the insured? The borrower. How does the death benefit change? It declines as the loan balance decreases. And can a lender require credit insurance? Generally, no. Some exam traps: the family does not get the money. The coverage does not stay level. The credit life is mortgage protection. It's not the case. And credit life replaces personal life insurance. It does not. Okay, it's just a debt-specific instrument. So remember, the insured is the borrower. The beneficiary is the creditor. The benefit declines, and the coverage is optional. Okay. So that's the lesson summary, basically everything we just said. Want to make sure you remember this. And again, knowledge check. Grab this off of the slides if you'd like to. You can pause and take a screenshot. And thank you very much. So in today's training, we're going to understand one of the most and oldest types of life insurance, called industrial or home service life insurance. This does show up on the exam at times. So it pays just to have a brief understanding of how it works and how it differs from, say, final expense or other forms of life insurance, and being able to answer it confidently when it does show up on the exam. So what is industrial or home service life insurance? Typically, it's permanent life insurance with small face amounts, with premiums traditionally collected weekly, sometimes monthly, and collected by an insurance agent actually coming to the policy owner's home. Okay. You may also have heard of debit insurance, okay, because they keep a debit of the policy holders they visit. So historically, it helped working class families afford life insurance. And there, believe it or not, there are still agents that do rounds on debit routes picking up premiums. I used to see it all the time when I would be in the field. I'm like, they still do that? And that was like 15 years ago, but there are agents who still do it. So why was it created? Because industrial life insurance developed to meet needs of working class families. And it became popular because of how it fit in how people actually lived and paid for things at the time. So again, if we think back in the day, people didn't have very many savings. Wages were paid weekly. Burial expenses would be a huge immediate burden, and annual premiums are out of reach. And so banking access was limited. Automatic drafts didn't exist. Families didn't have checking accounts. Cash payments were common. And so that's where agents could come in and visit on a recurring basis to collect premiums. And that's why they came to their house. That's why it's called home service. And there you go. So typical policy characteristics: it's permanent life insurance, typically whole life. There's a guaranteed death benefit, cash value accumulation, all this typical stuff with permanent coverage. But the coverage was a lot smaller than ordinary life. So you may see things like $500 plans, $1,000, $2,500. There are higher amounts, but again, we go back in time. Even these amounts used to be enough to take care of the funeral. So this is what you would see a lot. Okay. So many times they were just called flat out burial plans. Okay. So now some states define industrial life policies as face amounts under 1,000. So just make sure as you go through your state exam prep course that you answer it in the way that the state specific course suggested. So there's frequent premium collection, weekly, biweekly, monthly, and the agent would just pop in over at the person's house. And again, it was paid weekly because it was just more affordable for people on a fixed income. So advantages, it's easy to qualify for, permanent coverage, really designed for burial protection, first life insurance plan for many families. It's definitely a higher cost per thousand because there's higher administrative costs, smaller death benefits, less efficient than modern policies to pick up. So that's why you don't see it as often as you do now. This is just a comparison if you want to check out the differences. And then sometimes people confuse industrial with final expense insurance. The main difference with final expense insurance is that it's bank drafted. There's larger benefit amounts. The agent does not have to come by. They may come by in the first payment, but they don't have to, or the first application visit to get the person approved. But after that, there's no more visits required. And final expenses basically replace this entire business model, which is why you don't see it that often. So again, it's a historically, largely historical product. Door-to-door collections, all that's been replaced by electronic payment. So why is it on the exam? The laws still reference it. Some of these old policies, you'll see them still out there. It's crazy. And you just need to recognize them and understand that they're out here and understand how life insurance has changed. So some common exam questions include which policy traditionally features small face amounts with agents visiting door-to-door. Of course, that's industrial life. A policy designed primarily to provide funds for burial insurance with premiums collected weekly is, of course, called industrial life. And which statement is true? Industrial life has no cash value. It's temporary insurance. It traditionally uses home premium collection or requires annual premiums. The answer is C. So again, it's home. Home, home, home. They stop by for home collection, only small face amounts, modest death benefit, and enduring permanent whole life insurance. I like that acronym. So again, industrial life insurance is predominantly associated with small face amounts. Question 2, premiums are traditionally collected by agents visiting the home. D. Industrial life insurance most commonly provides permanent insurance. B. Just going through this real quick since it's pretty simple. Industrial life insurance is sometimes called home service life. Answer C. And then last question here before we wrap it up. Why are industrial life policies more expensive per thousand of coverage? Because of B, the higher administrative costs. Just think about paying an agent to go visit. It's just going to cost more. Okay. So that's it. If you need to screenshot this, here you go. If you want to download this slide, go to lifehealthexamcoach.com. The link's below, and we'll see you on the next one. In today's training, we're going to talk to you about specialized life insurance policies. So this is a really important training because there's a lot of policies that are more than just whole life or permanent or term. And we're going to go into some of these kind of like niche products so that you can better understand it. As many times they compare directly to what you're doing, and you need to understand how they work. And so that's exactly what we're going to cover on today's training. So like I said, what we've covered so far are the fundamentals of life insurance, like term, whole, universal, variable, group, and credit. And what we're going to do now is focus more on the specialized design. And they're generally built using one of these kind of frameworks or chassis, but they're specifically packaged to solve a particular financial need. And a lot of these exams now cover this because this is how a lot of plans are sold. And they address different ways to solve client problems with insurance products. Okay, so we're going to cover specifically family policies, family income policies, mortgage protection, modified death benefit policies, final expense, simplified issue life, and then guaranteed issue. So a family policy is where you combine an insurance policy for multiple families into a single contract. So what you see is a primary insured, a spouse as a term rider, and children as term riders. So the father, let's say, is $250,000 insured. The mom is $100,000 insured on a term rider. And then the term rider for children is $10,000. So bottom line, family policies are one contract with riders, not separate policies for each family member. So the pros and cons include, with a family policy, you have one premium payment that covers the whole family. It's convenient. It's all into one policy, and the children's coverage guaranteed regardless of future health, which is nice. Disadvantages include spouses and children coverage is often temporary. They're term riders. Coverage amounts for dependents may be limited. And if the primary insured dies, the riders may lapse. So family policies are built around one permanent policy with additional riders, not separate contracts for each family member. Now there's a family income policy, and this one is one of the most commonly tested specialized products, so it pays to understand how it works. So what it does, instead of a lump sum death benefit, the beneficiary receives regular monthly income plus a lump sum at the end of the income period. Okay. So some families struggle managing a large lump sum, and regular income replaces the deceased breadwinner's paycheck, keeping the household running month to month. So here's how the family income policy works. A decreasing term rider is attached to a permanent whole life based policy. As years pass, the monthly income obligation decreases because fewer years of income remain. So from year 1, the beneficiary receives $4,000 a month for 20 years. By year 18, the beneficiary receives $4,000 for only 2 years plus larger lump sum base. And the income period shrinks as the insured lives longer because the base policy lump sum remains. Okay, so here's some exam tips. So it's best for young families that have a primary breadwinner with young children at home and as an income replacement versus a lump sum. So family income policies are designed to replace income, not maximize the immediate lump sum. If the exam asks what a family income policy primarily provides, it's a monthly income replacement. Okay, family income policy, a monthly income replacement. Now let's talk about mortgage protection insurance, one of the easiest concepts on the licensing exam. What it does is just basically pay off the remaining mortgage balance if the insured homeowner dies. So the death benefit decreases over time as mortgage balance declines and the premiums stay level. The family is typically the beneficiary. Usually proceeds are used to pay off the mortgage. Now in some older or lender-placed policies, the lender may be the named beneficiary directly. Now, mortgage protection is most often tested as a decreasing term policy, declining benefit level premium designed to match. Now, we say test because in actuality, it's not sold this way anymore, but we're trying to pass an exam here. So answer decreased in term is what I would suggest. So how does it work? The premium stays level throughout the policy. The death benefit decreases as the mortgage balance declines. So you have a 30-year mortgage for $300,000. By year 15, it's $170,000. By year 30, it's $0, and the policy ends. Okay. So level premium plus declining death benefit is mortgage protection. So here's the difference between credit life and mortgage protection. Remember, you can screenshot this or download the slides and study. You can go to lifehealthexamcoach.com or look below in the description box to get them for free along with flashcards and exam practice questions, okay? So in short, mortgage protection equals house debt. Credit life equals consumer debt. That's the big difference. Now let's talk about a modified death benefit policies because they're very common, especially with the aging range of clients that are out there. So they are policies designed for individuals who cannot qualify for traditional life insurance due to health issues. So you often see them sold to seniors or people with serious health conditions or those declined in the past. So the key term here is their graded death benefit period. So the policy phases into full coverage over time. This is the exact phrase that's used in most state licensing exams. So how does the modified death benefit work? And what exam traps should you be worried about? So insurance companies use this structure to reduce adverse selection. The idea being that applicants with severe health issues carry much higher early mortality risk. So it looks like this: graded death benefit for years 1 through 2. If the client dies from natural causes, there's a limited benefit, often the return of the premiums, meaning a refund of the premium, plus some level of interest or a percentage of the amount of coverage, the face amount. And then the accidental death is paid out fully if the person dies of accidental causes. Then in year 3, the full coverage comes into effect. So now modified benefit does not mean lower premiums forever. It means limited early death benefits. That's the key thing. During the graded benefit period, premiums are often higher, not lower than, say, non-modified death benefits. Final expense insurance is a rapidly growing market. That's actually what I run my agency through and what we focus on. And it's designed to pay for end-of-life costs, including funeral expenses, burial costs, and outstanding medical bills. So burial cost, all this stuff. And typically you see $5,000 to $50,000 in coverage. Most are in the $10,000 to $15,000 range. So these are smaller policies. They're not designed for income transfer or wealth transfer. They're just designed to pay final expenses. So who buys it and why? Typically people who need simplified underwriting. There's usually no medical examinations. There's few questions, sometimes no questions. It's often whole life insurance, permanent coverage. Now premiums are higher per dollar because the people typically are older and have health issues. So common buyers include people 50 and older, people on a fixed income, those who want to avoid burdening family with funeral costs, and people who don't qualify for larger plans. So simplified issue life insurance is final expense, but let's explain this a little bit. But it doesn't always have to be final expense. So simplified issue life insurance is no medical exam required. The applicant answers a short set of health questions, and then the insurer uses those questions or answers to make an underwriting decision. So the advantage of this is faster approval, usually in days, not weeks. No medical exam, blood draw, peanut cup kind of thing. available to people with minor health issues too. The disadvantages are higher premiums than fully underwritten policies, lower maximum face amounts than fully underwritten policies, and can still be declined based on health questions. So the key distinction here is that simplified issue has health questions but no exam. You still can be declined. And last but not least is guaranteed issue life insurance. So this is no medical exam and no health questions. Acceptance is guaranteed. You cannot be declined based on your health. So for the exam, remember, guaranteed issue means no questions, no exam, no decline, but highest cost and graded death benefit period applies. So again, all of that, typically you see an age requirement of having to be at least 50 to 80, although there are some plans you don't, and some plans go above that. So trade-offs are the highest premiums of any life insurance policy, but you would only use this if there's no other options in many cases. Small death benefits and typically graded benefits apply. So the typical buyer is somebody in very bad shape, severe health issues, previously declined, and they just need to be buried. Okay, so this is the difference between simplified issue and guaranteed issue. Screenshot that or download the slides to study it. Simplified issue can decline you, guaranteed issue cannot. Remember the distinction. So this is the other niche products at a glance if you want to look through these. Sometimes these are tested on. It pays to know the difference and at least study the differences here. Okay, so understand that key person and buy-sell insurance appear more frequently on exams. Know who owns the policy and who benefits. Pre-need and burial insurance are tested conceptually. So comparing specialized plans, feel free to do all of these on your own and understand the primary purpose and key exam facts and differences. So some real quick questions here. Which policy typically has a declining death benefit? The answer is C, mortgage protection. The others don't. Question 2, which policy guarantees acceptance regardless of health? And that's guaranteed issue because it's guaranteed acceptance. Answer B. Question 3, family income policies predominantly provide estate liquidity, investment growth, monthly income replacement, increasing death benefits. Remember, family income policies mean monthly income replacement. Answer C. And then question 4, modified death benefit policy usually limit benefits during the entire policy for several policy years after 65 or after retirement. So it's modified just for the first couple of years. So the answer is B. Last couple of questions here to test on. Which policy is specifically designed to pay off a home loan if the insured dies? Is that a credit life, family income, mortgage protection, or guaranteed? Remember, home and a mortgage. So the answer is C. And question 6, which policy generally requires applicants to answer health questions but no medical exam? Is that guaranteed issue, simplified issue, modified, or family income? Typically, it's B, a simplified issue plan. In today's training, we're going to talk about life insurance riders, the most tested life insurance policy items on the licensing exam. They're all going to be tested. You need to understand the distinctions. We're going to talk about the exam traps, common questions, formats, all that good stuff so that you can be prepared to pass it and do well. So that's our objective here, is to define policy riders, their purposes, to distinguish between the differences, match riders to appropriate client situations, and then answer common licensing exam questions. So what is a rider? A rider is an optional provision attached to a life insurance policy that adds, modifies, or restricts coverage. So you have the base policy that provides the standard benefit, fixed terms, it's issued through underwriting, and then you have a rider, which then customizes the policy. It is added at the issue, sometimes later. Also, most require an additional premium, and then it becomes part of the contract once issued. So the key point here is riders are amendments to the contract. They do not replace the base policy. So riders covered in this lesson include protection riders, like waiver of premium or payer benefit, death benefit riders, value enhancement riders, and living benefit riders. Will cover all of them because they're going to be tested on. So waiver of premium rider, the most common one on the test. The trigger is total disability as defined by the policy, not necessarily unemployment. There is an age limit, typically 60 or 65, an elimination period, which means you have to pass through a certain period of time before you can start executing the rider's benefit. And the effect is the insurer pays future premiums because they're waived and not refunded. And the policy stays in force, coverage continues, and then the cash value, if any, keep growing. So example, John becomes permanently disabled. If there's no rider, the policy lapses, but with it, premiums are waived, the policy stays active, and beneficiary still receives the death benefit if the policy stays in force, according to the policy provisions. So understand disability must occur before the age limit, and the premiums are waived, not refunded. Being unemployed doesn't qualify. Next, you have the guaranteed insurability rider, which allows the insured to purchase additional coverage at specified future dates without the evidence of insurability. So this means no medical exam is required to exercise this option. You can do it at specific option dates like age, marriage, birth of child. New coverage premium is based on the insured's attained age, and health changes do not affect the eligibility. Age still matters. So you have Sarah that at age 25 buys a $250,000 policy, then gets diabetes at 28, but her guaranteed insurability rider allows her to purchase an additional $100,000 with no medical exam required or underwriting. And premium is based on her 28 age-year-old age rate. So exam trap here, health does not matter for exercising this option, but the new premium is based on the age attained, not the original issue age. Accidental death rider, sometimes called double indemnity. It pays an additional death benefit if death results from a covered accident. So let's say I have a base policy of $250,000. There's an accidental death benefit rider of an additional $250,000 for a total of $500,000 paid. And the rider pays in an accidental death, like a car accident, fall, drowning, but not in natural causes of death or illness from excluded activities. Okay, so it only pays for accidental death. So an AD&D, or accidental death and dismemberment plan, is more broader than just an accidental death plan. It'll cover for qualifying accidental injuries like dismemberment. Okay, and so like loss of a hand, foot, eye, 2 limbs, blindness. Benefit is proportional severity. Loss of 2 limbs or total sight pays the full principal sum. Single limb pays a fraction. Okay, so AD&D covers both death and dismemberment. The accidental death covers death only. Now there's a payer rider, which is designed for juvenile life policies. This protects a child's coverage if premium paying adults dies or becomes totally disabled. So applies to juvenile plans. The trigger is death or disability. The effect waives premiums on the child's policy, and the coverage continues until a specified age, typically 21 or 25. And you could lose the plan if the rider's not there, but with it, premiums are waived and coverage continues uninterrupted. So remember, the payer benefit rider is triggered by the payer's death or the total disability, not the insured child's. So also a term rider is very common. This adds temporary coverage to a permanent plan. So the purpose is to temporarily increase death benefit without buying a separate policy. It's the least expensive way to increase coverage. Coverage is temporary, so it expires at the end of the term. And to protect growing families, mortgage obligations increases coverage during peak earning years. So let's say you have a $100,000 whole life plan with a $200,000 term rider that gives you a total of $300,000 death benefit during the term period. And it's the least expensive way to temporarily increase the death benefit on a permanent plan. Child riders, of course, add term insurance to all current and future children on one rider. And the typical amount is small, $10,000 to $25,000, and a premium, flat premium covers all children in most cases to the age of 18 or 25. And then there's the ability to convert it without evidence of insurability. So it covers all children. That's the idea, future and existing children. There's also a cost of living rider, which automatically increases the death benefit over time to keep pace with inflation without requiring evidence of insurability. So it's tied to things like the consumer price index or a fixed percentage. The effect is the death benefit increases periodically, often annually. The premium increases as the death benefit increases, and the underwriting has no new underwriting. Okay, so let's say the CPI increases 3%, the death benefit increases 3%. You don't need to do an application, a new medical exam. Okay. Return a premium rider. If the insured outlives the policy or rider period, some or all premiums are returned. So this is most common with term life insurance. The premium is higher than standard term to fund the return feature. Premiums returned if insured survives the term. And there's a tax note. Return premiums are generally not taxable as they are a return of after-tax dollars. The trade-off is higher premium now in exchange for a guaranteed refund if you outlive the term. So for the exam, remember the return of premium rider results in higher premiums than standard term. Return premiums are generally not considered taxable income. Long-term care rider, a type of accelerated death benefit rider that allows the insured to use a portion of the death benefit while alive to pay for long-term care expenses. So things like nursing home, assisted living, home health care, adult daycare. So let's say you have a $500,000 policy. The insured enters a nursing home, uses $180,000 from death benefit from long-term care expenses, and then the remaining death benefit is paid to beneficiaries. So it's an accelerated death benefit. That's the idea. The insured accesses the death benefit while alive and benefits paid reduce the remaining death benefit dollar for dollar, it's not a separate insurance policy. So this is the rider comparison table. Again, you can download this at lifehealthexamcoach.com. Get the slides, this exact slide and all of the slides, along with flashcards, practice exams, and more. And then choosing the right rider. Let's talk about that. Match the client situation with the correct rider. This is a common exam format. So client becomes totally disabled, can no longer pay premiums. What do you get? Waiver premium. Client's health declines. They want to buy more coverage in the future. Guaranteed insurability rider. Client wants an extra death benefit only if death is accidental. An accidental death rider, double indemnity. Client wants coverage for accidental death and loss of limb or sight, AD&D rider. Parent buys life insurance on a child, wants premiums waived if the parent dies, payer or benefit rider. And client wants to use the death benefit nursing home costs while still alive, that's a long-term care rider. So these are the most common scenarios. Make sure you know, okay? So know these cold, which rider waives premiums during total disability, waiver premium. You guys can go through the rest of this. Again, screenshot this, practice this, very important. These are going to be tested, okay? And this is our knowledge check here. I'm not sure why it's formatted this way, but you guys can pause this, review these questions, go download these, like I said. And that's the lesson summary. So bottom line, guys, I know we blew through the last couple of slides, but know these cold, back and forth, the ones we covered, the most common, know what they are, how they customize policies, and know the distinctions and differences in order to pass the exam and get these questions right. Okay, in today's lesson, we're going to talk about policy options and settlement options regarding life insurance plans. So what you're going to learn are the 5 dividend options associated with life insurance, the policy loans and automatic premium loan provisions, the 3 non-forfeiture options, and the 5 settlement options. So this stuff shows up on the exam a ton, and you really need to understand how all this works. Lots of information, but we're going to jump right in and get them done. So again, we're going to know dividend options, policy loans, APLs, automatic premium loan, non-forfeiture options, and then settlement options, okay? So there's 2 types of options that you have. You have owner options during life, such as dividends, policy loans, automatic premium loans, and non-forfeiture options. Those are the owner options during life. And then death options for the beneficiary that are settlement. You're settling the claim. So things like lump sum, interest only, fixed amount, fixed period, life income. So remember, for the test, owner chooses policy options, beneficiary chooses settlement options. This distinction is commonly tested. So let's first talk with dividend options. So only participating or par policies pay dividends, okay? Non-participating don't. Dividends are not guaranteed in a plan. Considered a return of premium, not taxable income. That's nice. And policy owners chooses how dividends are applied. Again, frequently tested, dividends are not guaranteed. Remember that. So there are 5 dividend options you can choose. You can choose cash, so you can receive a dividend as a check. You can do it to reduce premium, apply towards the next premium due. You can accumulate interest, left with the insurer earns interest. That interest is taxable. You can do paid up additions, which buys additional paid up insurance, increases both cash value and death benefit. Or you can even do 1-year terms, which buy additional term coverage for a year. So paid up additions increase both cash value and death benefit. The only option that does both. Keep that in mind. Here's your dividend option comparison. So again, you can download this slide at lifehealthexamcoach.com to understand it a little more and practice it along with flashcards and exam questions. Paid up additions is the only dividend option that increases both cash value and death benefit permanently. We're reminding you of that because it's going to be tested, most likely. So policy loans work with permanent life insurance that builds cash value, and the owners can borrow against it. No credit check is needed. No repayment schedule is required. And the outstanding loan reduces the death benefit if unpaid, and the interest accrues on the loan balance. So policy loans are generally not taxable income. A couple of distinctions that are important. A loan's not a withdrawal. You are borrowing. You're not taking out money permanently, okay, when it comes to borrowing on a policy loan. There's possible taxable gain if the policy lapses or is surrendered with an outstanding loan. Taxable gains may result. And there's a reduced death benefit. So any unpaid loan balance reduces the death benefit at the time of claim. Now, an automatic premium loan, what's that? It is an optional provision, very common though, added to permanent life policies where if a premium's missed, the insurer automatically loans the premium amount from the policy's cash value. It keeps the policy in force, prevents lapsing, and then the interest accrues on the loan. So the idea is the APL uses cash value to prevent lapses. That's the key concept you're going to be tested on. Okay. So if a client has a $150 payment, they miss it, there's $6,000 available, the insurer loans $150 from cash value, and the policy stays in force. And then the loan balance grows over time. Okay. So you have to elect the APL in advance. It is not automatic unless provision is included in the policy. Okay. Non-forfeiture options, protecting the policy owner premium stop. So if non-forfeiture options are required by law in permanent life insurance policy, it protects policy owners if they stop paying premiums. They ensure the cash value is not forfeited, and the policy owner must choose one of the three options. Okay, so the key thing is it's required by law. They have to choose a cash surrender, take the cash value, cancel the policy, do a reduced paid up plan, use the cash value to buy smaller permanent policies with no more premiums, or purchase extended term with the cash value for the same face amount. So here they are side by side. If you want to take a look at those, you can. Again, for the exam, the reduced paid up equals smaller permanent policies. Okay, extended term means same face amount, limited time. Note the difference. Here's the non-forfeiture comparison table. Key thing here is extended term is typically the default non-forfeiture option if the policy owner makes no selection. Now let's talk briefly about settlement options. This again is how beneficiaries receive life insurance proceeds. So the policy owner beneficiary selects how death benefits are likely to proceed or are going to be paid. There's usually 5 options. So you have lump sum, interest only, fixed amount, fixed period, or life income. Again, how that gets paid out depends on the best use, as you can see in the table. And the key thing here to remember is that settlement options are chosen by the beneficiary or the policy owner in advance, can be done, and then apply after the insured's death. So here's a decision guide. How does the beneficiary want to treat their money? That's how they're going to go about this. So if they want it all at once, that's a lump sum. That's the most common. It's generally income tax free. If they want it over time, they get a fixed amount paid until the proceeds run out, a fixed period, equal payments until the period ends, life income, payments for life, stops at the beneficiary's death, or interest only, where the principal stays with the insurer, only the interest paid out, often temporary. So the key thing to remember here is fixed amount equals you choose the amount, choose the payment, fixed period, you choose the time, life income, insurer takes the mortality risk. So a couple of licensing exam scenarios. Policy owner wants to use dividends to increase both the cash value and the death benefit. The answer, dividend option should be paid up additions. That's the only one that does both. Next on the list here is policy owner stops paying premiums but wants lifetime coverage with no future premium payments. That's called reduced paid up insurance. Converts cash value into a smaller permanent plan with no more required premiums. And then beneficiary wants guaranteed monthly income for the rest of their life. That's a life income option, which converts death benefits into guaranteed life income payments. Some common exam traps. Dividends are not guaranteed. Paid up additions increase both cash value and death benefit, the only option in dividends. And policy loans generally are not taxable, but if a policy lapses without outstanding loan, there may be a taxable gain. Reduced paid up versus extended term. Reduced paid up is a smaller permanent plan. Extended term is the same face amount for the limited time. They're not the same. Extended term default, that's the default non-forfeiture option. Then settlement versus non-forfeiture. Settlement options apply after death. Non-forfeiture and dividend options apply during the policy owner's lifetime. So here's a huge cheat sheet, guys, for you. Make sure that you note this down. Again, download my slides at lifehealthexamcoach.com if you'd like those. So some knowledge checks here. When does the dividend option increases which dividend option increases both cash value and death benefit? Cash interest paid up reduced. It's cash paid up additions. Question 2, which non-forfeiture option is typically the default? The answer is extended term insurance. Question 3, a beneficiary wants income for life. Is it fixed period, fixed amount, life income option, or lump sum? The answer C, life income option. And that's it. That's our summary here. Make sure you note all of this on here, just a repetition of everything we talked about, and see you on the next training.